Okay. So our next question will be on intangibles. What do we call intangibles? Intangibles are those non-current assets that cannot be seen. They are of what? They are not of any physical existence. You can't see them. They are assets. They belong to a company. They are assets that a company might acquire, might purchase. But this asset does not have physical what? Existence. They don't have physical substance. You can't feel them, you can't touch them. But they belong to the company. Example will be trademark. Example will be the patent rights, the copyrights, the license that the company is going to acquire from government and all those things. Those assets that is going to be having uh economic benefit, but they cannot be seen. They are of no physical substance. That is what we call the intangible asset. You see, the accounting for the intangible asset, it follows the same principle for the PPI 16. When do we recognize intangible? The first and the important one is that if the cost can be measured reliably, we recognize an intangible. If it is it is probable that future economic benefit will flow into the entity, it can also be recognized. So the recognition criteria for an asset also applies to the intangible asset. But the most important one is that the measuring the cost reliably. If the cost of the intangible can be reliably measured, then you can go ahead to recognize what an intangible. Therefore, all intangibles that are acquired through acquisition, they are acquired through outright purchase. The company is paying for them. We can determine the amount of money that we are paying for that particular asset. For that reason, we can recognize it. But if you come to a letterhead, an employee of the company has designed a letterhead. Okay, we are paying this particular person a salary every year or every month. And as part of the person's work, the person has designed the letterhead for the company. Okay, the designing of the letterhead is part of the person's day-to-day work. So we cannot be able to say that, okay, it is this part of the salary that we have paid for the letterhead that the person has designed. No, the cost of designing the letterhead cannot be what? Differentiated from the salary that we are paying to the person every day. So the person is doing that, or the person is designing the letterhead as part of his normal work. So we cannot say that this portion of the salary is for the letterhead and this portion of the salary is for the normal activity that the person is doing. So for the letterhead, the company cannot recognize the letterhead because the cost of developing a letterhead cannot be separated from the normal salary that we are paying to the person. Although the letterhead will be an intangible asset, it's a property to the company, it's going to give the economic benefits. But what amount can we attach to the letterhead in the books? We cannot measure the amount. Therefore, the letterhead cannot be what? Cannot be recognized as an intangible asset. You can only recognize an intangible asset when the cost of developing that particular intangible asset can be measured what? Reliably. It's very important. The reliability measurement of the cost is very important. We also have advertising costs. We have some costs, we have some items that although they are going to give economic benefit to the entity, they cannot be recognized as intangible. Why? The company might not have control over them. The company might not be able to sell them in a separate transaction. It cannot be sold in a separate transaction. Let's come to advertising costs. The company has spent so much to advertise for a product. The company has spent so much to advertise for products. Now we want to sell the advertisement to a different company. We want to sell the advertisement to a different company. We can sell that particular one. But the cost that we are going to be spending on advertisement, the cost that we are going to be spending on it, although if you do the advert, the advert you are doing the advert for a product. So the advert is going to give the economic benefit to the entity over time because if you do the advert, people will now be aware of the product. And for the lifetime of the product, maybe the product will stay for 5 years. You see that the advert will now boost your sales for 5 years, although it is going to give you economic benefits, which will be consumed over, okay, although it's going to give you benefits over time, we cannot recognize this because we cannot sell the advertisement cost in a separate transaction. It cannot be sold as an item on its own. The advertisement cost cannot be sold as an item on its own, like how we can sell a license or how we can sell property, plant, and equipment. The advertisement cost cannot be sold as a separate item. So therefore, the advertisement cost cannot be recognized as an intangible asset. These are the technicalities that they will be examining you on. Another one is also a training cost. Okay, the company might develop a software that they want to use, or they might purchase a software that they want to use. Okay, before they can start using the software, they have to what? Train the staff on how to use the software. First of all, you have to know that the staff are going to be with the company, but these people can leave the company at any time. So you can see that the training that will be given to them, they will use the training to help the company to run the software for some time. But does the company have control over these people? No. The staff, the employees can leave at any time. If they leave, they will leave with the knowledge that they have acquired through the training, and you don't have control over those ones. So training costs can never be what? Can never be capitalized as an intangible asset. It can never be classified as an intangible asset. However, if the question says that a company has a contract with the employees, that the employees cannot leave the company up to a certain number of period, or maybe they are saying that, okay, the company has a contract with the employees and none of the employees will be allowed to leave within the next 4 years. In that case, the company can capitalize the training course and assume that the training course will be what? Will be consumed, the benefit will be consumed over the what? Over the 4 years. So the company can capitalize the training course and amortize it over the 4 years. But if nothing like this is being said, the training course should be expensed as when it is what? Incurred. The initial recognition, what will be the cost, or what are the costs that will form part of what? Of the intangible asset. Any cost that is incurred to bring the asset to the state that it can be ready for use should be added to the initial cost of the asset. So the capitalization follow the same principle like the tangible asset, the PPE. Any cost that you are going to incur to bring the asset to the state that you can start using it will be capitalized, will be added to the initial cost of the assets. So we can also use this reason and say that training costs cannot be what? Cannot be capitalized. Because even if the staff are not trained, the company can outsource what? The running of the software. They can take someone from outside who will come and run the software for them. So the software can be run without training the employees. So we can also use this reason and say that training costs can never be capitalized. So sometimes they will be giving you certain costs. You have to expense them. The next one will be advertising costs, training costs, customer list. They will give you some items. Okay, you have to expense them. You only add the cost that is incurred with the purpose of bringing the asset ready for what? Ready for use. Any cost that is incurred after the asset is ready for use must be subjected to the principle of capital expenditure and also the revenue expenditure. A capital expenditure is an expenditure that is going to improve upon the efficiency or is going to extend the useful life of the asset. Example is an extension to building, of carrying out or changing an engine of a car. Those are what we call the capital expenditure. And those costs must be added to the carrying value of the asset as at the date that the extension or the new engine has been fixed. Okay. Another crucial issue under the intangibles is the research and development cost. Sometimes the company will want to undertake a research or they want to develop a product. Before they can start producing the product, they would like to see whether the product will be successful or will be profitable or something like that. So they will carry out what we call feasibility studies. they will carry out feasibility studies. Okay, the feasibility studies, what they will do is they will incur some cost on the feasibility studies. You see that the research cost, whether you decide to continue with the product or not, you will still incur that particular cost. Whether you decide to continue with the product or not, you will still incur that particular cost because after the project, after the feasibility studies, you can say that you will not continue. You have already incurred the research cost already, so you can't do anything. So research cost, whenever it is incurred, it should be written off immediately to profit or loss. Then after the research, you have decided to now start producing the what? The product, or you have started to developing the product now. You have you have decided to start developing the product. Okay, if the product has gone to the development stage, you can only start capitalizing the development cost when management is convinced, or capitalization of development cost will start from the day that management is convinced that the project will be successful or the product will be successful. So you can development development can start from research can start from January to March. Okay, development will start from April to December. Okay, but the question will tell you that it is on June, at the beginning of June, that management is convinced that the product will be successful. You will start capitalizing from June to December. The meaning is that from April and May, this development cost will still be what? Will still be expensed as if it is a research cost. So capitalization will start when management is convinced that the product or the project that they are undertaking will be what? Will be successful. Capitalization of the development cost ceases when the product is available for what? For, for use or for sale. You have to take note of these particular issues. Okay, these are the few ones that I can talk about for financial reporting. If you go to corporate reporting, we have some other issues that I can talk about over here. So the recognition of the intangible has to do with if you can measure the cost reliably, if there's an evidence that future economic benefits will flow into the entity, or through the usage of that particular intangible asset, the entity will be able to what? To benefit from it, or there will be a future economic benefit that the entity will be getting from the usage of the intangible assets. The cost measurement is very important. Any intangible that is developed internally means the letterhead that I've spoken about. The cost of developing the letterhead cannot be determined separately from the salary that we are paying to the designer. In that case, the letterhead will be seen as internally generated what? Intangible asset. We should be what? Not be capitalized. We should not be capitalized. Okay, let's take the question one. I hope I have said a lot and you have also learned a lot. If you have any question, you can bring it before we pick the question. Yeah, senior.
Yes. Good evening, sir.
Yeah, good evening, senior. I hope you are doing well.
Please, my questionable assets. It's a question I have from yes, please. It's a question I had from yes. Clarification on that. It has to do with the issuance cost. Please, I wanted to find out if the cost is issued. I understand from yesterday's lesson that it has to be amortized through the profit and loss. But my issue is, would do we I mean the bulk amount, is
Okay.
it supposed to be added to maybe the liability? And as you amortize through the profit and loss, you go and subtract that component, or you just lesser from the profit and loss?
Okay.
Or is it that it's so? Please, that's what I want to understand. I hope you understood what I
Yeah, yeah,
said.
yeah.
My question.
Okay. You see, mostly the questions that you have been seeing is that they will give you effective interest rate, isn't it? Okay. They will
Yes,
give you
please.
the effective interest rate of the loan. Okay. The meaning is that, okay. The meaning is that if we are issuing a loan, the loan is 2,000 and we are issuing at a percentage of 5. as at an interest of 5%. Okay. And the
Yes,
issue
sir.
cost is, let's assume that the issue cost is 500. The loan will last for 5 years. Okay. Let's come here.
Sir. Yes, sir.
Let's come here. You see that at the end of every year, what will be the interest that you'll be paying on the loan?
The interest would be the amount times the effective interest rate.
No, we don't have effective interest rate, but we know that we are issuing a loan note for 2,000 and the loan note carries an interest of 5%. So what will be the
5%.
interest that you'll be paying on the loan every year? Let's calculate that particular interest.
So the 5% of the amount.
100 cities.
That will give us 100 cities, isn't it? Okay.
Yes,
The,
sir.
Yes, sir.
the issue cost is an expense, isn't it?
Yes, sir, it is.
Okay. The issue cost is an expense. But this issue cost is relating to an instrument that will last for 5 years, isn't it?
Yes,
Okay.
sir.
So it means that we can also say that the issue cost should be consumed over 5 years. So every year we'll be having 100, isn't it?
Yes, sir.
Okay. So what will be the total expense that we will be sending to profit or loss?
And please, the interest and the borrowing and the amortized cost of the issue cost. I think
Okay.
the 100. So you are going to have two components, 200.
Okay. Okay.
So
But
the
what we
100 for the finance cost and 100 for the amortized
okay.
cost.
Okay. But what we are doing is that we are saying that we want to what? We want to capitalize this particular cost, isn't it?
Yes,
Okay.
please.
Capitalizing means that we should add or subtract it from what is bringing the cost. Okay. So if you are capitalizing this cost, you see that you now be having 19,500, isn't it? If
Yes,
you are,
sir.
okay. But you know that at the end of every year, you should send 200 cities to the statement of profit or loss, 100 cities for the instrument, and 100 cities for the amortization of the loan. But you can see that since you have capitalized the transaction cost, you are now having a value of what? 19,500, isn't it?
Yes,
Okay.
sir.
We know that every year we should be sending 200 Ghana cities, isn't it? Okay.
Yes, sir, it is.
The question now is what rate? Because instead of us amortizing or putting the transaction cost and what amortizing it every year 100 plus the interest 100, we have decided to subtract it from this one. So we need to find a rate now so that if you apply the rate on this particular figure, it will be giving your 200 cities as a total expense every year. So how do we find that rate? You have
Okay.
200 over 19,500 times 100%. What are you getting?
Okay.
What are you getting?
100.
1.03.
1.03.
It's supposed not to be because 5%. Oh, it's not 19. It's supposed to be
Please, you
it's
then
1,500, isn't it?
1.0,
No.
1.1%.
If you subtract 5%, 500 from 2,000, it's supposed to be 1,500, not 19,500, because the figure is not 20,000. Are you okay?
Yes, sir.
The loan amount is 2,000, not 20,000. I'm assuming that it's 20,000. So it's supposed to be 1,005.
So it's 13.33.
Okay. It should be 13 point what?
33.
Okay. The 13.33 over here is what we call the effective interest rate. So the effective interest rate, what we do is that we are subtracting the issue cost from this. So the figure that we'll be getting now will be lower than the coupon itself. So we want a rate so that if we apply the rate on the residual value, it will take into consideration the interest of the 100 and also the issue cost of 100. So you can decide to apply the 13.33 on the 1,005 and see whether you are going to be getting 200. And that 200 has a component of the issue cost and a component of the what? Of the interest. So in actual sense, the interest on the instrument is always the interest for the coupon. It's always the interest of 100. That's why you say that the company is paying the coupon. That is the actual interest on the what? On the instrument that you are issuing. But the reason why the effective interest rate or the finance cost is different from the normal interest or the coupon is the effect of the issuing cost that you have subtracted. Okay. So the question will always give you the effective interest rate. If they give you the effective interest rate, it means that they have taken into consideration the amortization of the issuing cost. So you can subtract the issuing cost from the nominal value and now apply the effective interest rate. But if the effective interest rate is not given to you, it means that you are going to be amortizing they have given you only 5%. This 5% is for the loan itself, is for the loan, which is the 2,000. So this interest rate is for the 2,000. So the 500 will also be capitalized separately. But if you are giving effective interest rate, it means that they have now taken into consideration the impact of the transaction cost after you have subtracted from the nominal value. Okay, so but in the exam, they will always give you the effective interest rate. They give you the effective interest rate. It means that the residual value has been the transaction cost and also the interest on the loan or on the bond that should be taken to profit or loss has been taken into consideration before calculating the effective interest rate. And that is why the effective interest rate will always be higher than the coupon rate. The increment over there is as a result of the issue cost being subtracted from that particular figure. Sin, I hope I have answered your question in some way.
Yes, please. Thank you very much. God bless you.
All right, you're welcome. Okay. Do you have any other concern? Yeah. So these things, we take time to do them in normal class. Okay. And if you follow me on YouTube too, like the dawn classes that I've been doing Saturday, I take my time to explain these things. You don't have, not that you should just memorize the thing in your head and be going. No. After the exam, you see someone, a person will ask you, explain this for me. You say you are a chartered accountant, but you cannot explain why the company is making an annual transfer from revaluation reserve to retain earnings. My brother, how? Let's take the question. The A. Who is reading for us? Auntie Bennett, are you there?
Okay.
Okay.
Question 1.
Okay.
The following transactions pertain to Amuse Limited. A. In 2020, AL started development of a new product. The recognition criteria for capitalization of internally generated intangible assets was met on 1 January 2021. On this date, AL started development of a plant which completed in 3 months. It is pilot plant for testing the new product and is not of a scale economically feasible for commercial production. AL incurred costs of 3 million cedis and 7 million cedis on design and construction of plants respectively. AL expects to operate the plant for 2 years till end of development phase. During 2021, AL incurred 5 million cedis in operating the pilot plant.
Okay. Let's take the B. Let's take all of them at once and explain.
Okay, B. On 1 March 2021, AL acquired a patent with indefinite life in exchange of its old equipment and cash consideration of 25 cedis million. The fair values of the patent and the equipment were assessed at 57 million cedis and 35 million cedis respectively. On the date of exchange, the equipment had a carrying value of 30 million cedis. AL believes that its future cash flows will change as a result of this exchange. AL incurred costs of 2 million cedis for transferring the title of the patent to its name. C. On 1 June 2021, government granted a license to AL free of cost to import raw material up to 10 tons from international markets for its intended use. The license is non-transferable. There are no further conditions attached by the government. The fair value of the license is 50 million cedis.
Okay. Explain.
Required. Explain how each of the above transactions should be accounted for in the financial statement of AL for the year ended 31 December 2021 in accordance with the requirements of IFRS.
Okay, let's take the first one. Seniors, this is about what? Intangibles. Okay, you can see you have certain costs over there. But first of all, before you can look at those costs, let's see the criteria for capitalizing internally generated intangible assets, like the development expenditure, has been met as a criteria for capitalizing the development expenditure. Has it been met? Has it been met?
Yeah.
Okay. On what date?
1st January 2021.
Okay. And the company started development of a plant which completed in 3 months, isn't it? Okay. It is pilot plant for testing the new product and is not of a scale economically feasible for commercial production. The company incurred a cost of 3 million and 7 million on design and construction of the plants respectively. Do you know the design that they are talking about? Do you know the design that they are talking about? What design are they talking about? Okay. The design of what? Okay. They are talking about the design of the product. Okay. Whenever the question can give you prototype, they can give you design, they can give you certain things. Prototype is just like a design of the product. You want to show the product to people. So you can only do a sample of the product, do a prototype when you are convinced that the product is going to be successful. So whenever the company has designed or the company is now, or the question give you a prototype, it means that the company is now in a development stage and management is convinced that it will be successful. So the product design, the prototype, the sample, and all those things should be capitalized. Okay, so they have designed a product for 3 million. This 3 million should be capitalized because you can only go ahead to design the product when you are convinced that the product will be successful. Okay, so the 3 million will be what? Will be capitalized. But the question now is the product ready for use? Is the product ready for use? Based on what we are given, is the product ready for use? Based on the information that we have, is the product ready for use?
No.
Okay. Why are you developing the machine? The plant that you are developing, the plant that you constructed, what's the purpose of it?
Is to produce the good.
Is to test. It's not to produce. It's to test.
No.
Okay. Can you go ahead to the next stage of the production if you are not testing the previous stage? Can the production go on without testing?
No.
Okay. So the question is, they are saying that this particular machine is expected to operate the plant for 2 years till the end of the development phase. So it means that the machine is only constructed purposely for the product. So it means that after the product has been completed, the machine cannot be used elsewhere. So you can see that they say that the machine is not of a scale economically feasible for commercial production. It means that after the production, you can't use the machine elsewhere. Assuming you can use the machine elsewhere, and the company says that the machine is going to be having a useful life of 7 years. Okay, the machine can be used elsewhere, and it's having useful life of 7 years. It means that the first 2 years you are going to use it on a product. So you are now calculate the depreciation for each year, which will be 1 million. Then you will now capitalize only what? 2 million. because you are going to use it on a product for 2 years, and the remaining 5 years will be used elsewhere. But they say that the machine or the plant is not of a scale feasible for commercial work production. It means that after the product is being completed or the development is completed, the machine will become useless. It cannot be used elsewhere. So it means that we are developing, or we constructed a machine purposely for what? For the product. And it is part of the activities that we have to carry out for the product to be ready for use. So the 7 million will also be what? Added to the 3 million. Because it's part of the activities that we have to, or it's part of the cost that we have to incur for the product to be ready. So it's part of the development cost. Okay, let's come to the last one. During 2021, AL incurred 5 million in operating the pilot plants. If you are testing, it means that you'll be operating the machine, isn't it?
Yeah.
Yes, ma'am. If you are testing, it means that you will be operating. You can't just say you are testing without operating the machine. Okay. When are we incurring this operating costs? Is it after the product is ready or before the product is ready? The product is ready.
Before.
Okay. Can you test the product without someone controlling or someone running the plant?
No.
No.
Okay. So therefore the 5 million will be capitalized or will be expensed.
Capitalized.
Capitalized.
It will be capitalized. You can't test without incurring the operating cost. So the operating cost is also a cost incurred before the product is ready for use. So any cost that you incur directly on a product before it is ready for its intended use, all those costs must be added to the initial cost of the asset. So you can see that the product is still in the development stage. We can't move on to the next stage without testing the product. And the plan that we constructed is purposely for the testing. So that will be seen as a testing cost. So we add it. We can't test. Can you just put a machine over there? The machine will be operating on its own. No, we are going to use people. And the people, we are paying them 5 million. It is not after. The product is not ready to generate economic benefits. So we can't say we are expensing it. We only expense because that particular amount will be used, or we are going to use it to generate economic benefit during that particular year. So we expense it. But there is no revenue for us to expense this particular amount against. The product has not started generating economic benefits. So the company should capitalize the design cost of 3 million, the 7 million, and also the 5 million. So in all, they will be capitalizing, or they will be having a development cost of 15 million in their statement of financial position. Are we okay with the explanation? Or there's something that we don't understand and we want to talk about it again? Genius, are you okay? Can we move on? Can we move on in peace or in pieces? Let's
Let's
move on. We should move on in peace, isn't it? Okay.
Yes, sir.
Okay. You have to know that an asset can be acquired or can be owned through so many ways. It can be purchased, it can be outright purchase, where you go to the market and buy the assets. Okay, you can own the asset by buying it yourself. You can also own the asset by constructing it yourself. You can also own the asset by a lease. You can also own the asset by what we call exchange. You have a land, you want a car. You can give the car in exchange for what? For the land. But what do? You have to determine whether this particular transaction is having a commercial substance or not. And what is the indication, or what are the indicators of a commercial substance? The question will tell you, or they will give you an information in the question that will tell you that this particular transaction is of a commercial substance. One of them is that the cash flow as a result of this particular transaction will change. That is an indicator of a commercial substance. So let's look at this question. How is the company acquiring the patents? Are they paying cash or they are paying cash together with something?
An exchange
Okay.
of
So
it.
they are doing exchange and they're also paying a certain amount of money, isn't it?
Yes.
Okay. What is the value of the patent?
$57 million.
Okay.
Yeah.
Yeah, it's 57 million, isn't it? Okay.
Yes.
And the carrying value is what? Carrying value of the equipment that we are exchanging plus the cash is what? It's 30 million.
25 million.
No, the cash that we are paying is 25 million. But the equipment that we are giving in exchange, it has a carrying value of 30 million.
30 million, yes.
Okay. The question is, at what value are we going to recognize the patent? If you are putting the patent in your books, what value are you going to attach to it? That's what we are looking for right now. The question is saying that A believes that its cash flows will change as a result of this transaction. So it means that this particular transaction is of a commercial substance. If it is of commercial substance, the asset that you are receiving should be measured at fair value. So if the transaction is of commercial substance, then the asset that you are receiving should be measured at fair value. Or maybe the fair value cannot be determined. Then you just measure it at the carrying value of the asset that you are giving out. If the fair value cannot be determined, you measure it at the carrying value of the asset that you are giving out. But this particular transaction is of commercial substance. Okay. The question now is, can you be giving something that's worth 35 million for something that's worth 25 million? Can you do that? If the transaction is of commercial substance, it means that you are trading on a commercial term. No favoritism, nobody's cheating anybody. We are trading on a commercial term. If you go to the market right now, what is the value of this one? So I'm saying that, can you give an item that worth 35 million for an item that worth 30 million? Can you do that?
No.
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 Yeah. So if they say the transaction is of commercial substance, it means that how would this thing be treated in the market? If I'm giving you a motor that is 35 million, it means that you should give me a car that is 35 million. It is of commercial substance. If you go to the market, you will bring 35 for 35. Okay. So it means that the 35 million of the equipment that we are giving it for the value of the patents. Okay. So the total value of the patents will now be the cash that we are paying plus what? The 35 million. And that will give us 60. Okay. That will give us 60 million, not 57 million. The patent will be recognized at what? At 60 million, not 57 million. Because whatever we are giving out, we are giving it for the fair value. We are giving it for the fair value of the patent. The transaction is of commercial substance. So whatever I'm giving out to you is equivalent to what I'm receiving. I can't give more than what I'm receiving. I can only give up to what I'm receiving. That is the commercial substance. So you are giving 25 million plus the equipment of 35 million. So you are giving 60 million for the patents. I can only give you up to the what? The value of what I'm receiving. I can't give more than, I can't give less. So the patent will be recognized at 25 plus the fair value of the asset, not the 57. Not the 57. So if the transactions of commercial substance, you are giving exactly what you are receiving. You can't give more, you can't give less. So you ignore the 57 and now recognize the patent as 60 million. But the patent, is it having a definite useful life or indefinite?
Indefinite.
Okay.
Indefinite.
Intangibles with indefinite useful life, what do we do to them?
Impairment test.
At when?
Every year.
Every
Okay.
year.
So let's count to this one. AL incurred a cost of 2 million for transferring the title of the patent to its name. So it means that the patent is in the name of the original owner. You can't start using it. What do? You have to do transfer of what? You have to do change of name. So it means that you can't use the patent with the person's name on it, isn't it? Okay. So before you can use the patent, it means that you have to do the change of name. So this particular cost will also be capitalized. So we have 62 million because it's part of the cost that you have to incur to bring the patent to the condition that you can use it. Someone's name is on it. You can't use it. If you're using it, you are using it in the name of that person. It's as if it's for the person. So before you can start using it for yourself, you have to do the change of ownership or the change of name. Without a change of name, you can't use the patent in your own name. So the change of or the cost of changing the name is seen as part of the cost incurred to bring the patent to the state that we can start using it. So the patent will be recognized as 62 million initially, and at the end of every year, impairment test should be carried out on the what? On the patent, because assets with indefinite useful life are subject to compulsory impairment test at the end of every year. We have three assets that we normally subject to what? A compulsory impairment at the end of every year. So that would be, we have the intangible asset with indefinite useful life. We also have goodwill acquired through business combination, and also intangible that are under construction, or intangible that are not yet ready for use, but they are still under construction, or the company is doing something about them for them to be ready for use. So intangibles that are not ready for use should also be what? Should also be tested for impairment annually. So the question, they can ask you in the exam that what are the assets that should be subjected to yearly or compulsory impairment. So you have to be able to list those ones. So the first one, the A, we are capitalizing the A, we are capitalizing the design cost. So let me just write them. We are capitalizing the design cost of 3 million. The plant, which is 7 million. The operating cost, which is 5 million. So we are having 15 million. Okay. If we come to the B, the patent, we are having the cash that we are paying of 25 million. We are having the fair value of the equipment of 35 million. And we are looking at what? The cost of transferring the name. That will be 2 million, and that will be 62. Yes, let's count to the equipment. What are we going to recognize any gain on the equipment? Will there be any gain to be recognized on the equipment? Will there be any gain to be recognized on the equipment that we are exchanging? Will there be any gain? 35 against 30. Will there be any
Yes,
gain that the company
please.
will be recognizing? Okay.
Yes,
A
please.
gain of
Yes.
5 million.
Okay. So
5 million.
that gain should be recognized in profit or loss. Okay. Let's count to the C. The C is what? You can see that it's intangible together with government grants, isn't it?
Yes.
Okay. For you to be able to know how to account for a transaction relating to IS 20, you have to understand the difference between government grants and government assistance. Government grants will always involve in a transfer of a resource, will always involve in a transfer of economic resource. Okay, it can be in form of cash. It can also be in form of a non-monetary what item. The government can give you cash, or the government can give you an item. They will transfer an item to you instead of cash. Okay, but government assistance, and there is no transfer of what? Economic resources. There's no transfer, but it's just like a help. It's just like something that you are going to benefit from, but they will not give you any economic resources. There will not be any transfer of economic resources. The first one is the tax relief. The government will not give you money. Tax relief, the tax relief, there is no what transfer of economic resources. The government now removing the tariff that they have on some imported items. That is not a government grant because there is no transfer of economic resources. So you have to be very careful with the issues with the government grant. Sometimes they can list an items for you and ask you to explain how you should account for them. Some of them will be a grant because there will be a transfer of economic resources, either in kind or in cash. But some of them, there will not be, if you read the transaction, there will not be any transfer of economic resources, but there will be a benefit that the company will be enjoying as a result of that particular transaction. And that should be a disclosure, government assistance. Government assistance are always what? Disclosed. They cannot be recognized because we cannot find the economic element in it. No amount of money can be attached to it. So let's come to this place. On 1st June 2021, the government granted a license to AR free of cost to import raw materials up to 10 tons from international markets for its intended use. The license is not transferable. There are no further conditions attached by the government. The fair value of the license is what? 50 million. Okay, you can see the government is not giving the company money, isn't it? But you can see that
Yes.
there is a transfer of economic resource, isn't it?
Yeah.
And
The license.
that is the license. So this is a government grant. So a transfer of a non-monetary item should either be recognized at the fair value or the nominal value. Okay, you can see that this license is not transferable. This license is not transferable. If the license is transferable, the company cannot recognize it because maybe the government can come for it and the government can come and take it at any time. So what you do is that maybe you can just determine the benefit that the license will be giving to you from the time that you are having it to the time that the government will come for it. And that will be treated as what? A revenue grant. But this is a capital grant. Something the license is going to last for a number of period. So the company should capitalize the license at the fair value. Sometimes they will not give you fair value. So you use the nominal value. And this will be capitalized at the fair value of 15 million. And it will now be amortized. It will now be amortized over the useful life of the license. That's how we go about it. Seniors, a minute. So, senior, sorry for that. I'm saying that if it should be, if the license should be transferable, then you just determine the number of period that the license will be with you and what will be the benefit that you'll be getting from that particular period. Then you just recognize it as a revenue grant because it will not be for more than a year or something. Even if it will be for maybe some years or the license will be with you for 5 years before the government will come for it, then you are going to be capitalizing the 50 and now amortize it over 5 years. Okay, so this one, since it's not transferable, maybe it will be with the company forever or maybe it will last for some number of years and the company has to recognize the 50 million as for the license, or the company has to recognize the intangible as a license and now amortize it over the useful life of the license. That is all about the first one. I hope we get it. Okay, let's come to the second one.
Question 2. Players' registration contract costs are shown by football clubs as intangible assets and are initially recognized at the fair value of the consideration paid for their acquisition in their financial statements. However, subsequent players' contracts are often renegotiated at a cost. Also, players' contracts may contain contingent performance conditions where individual players may be paid a bonus based on their success in terms of goals scored or the success of the football team as a whole. These bonuses represent additional contract costs. For impairment purposes, LERIACO does not consider that it is possible to determine the value in use of an individual player unless the player were to suffer a career-threatening injury and cannot play in the team. Players only generate direct cash flows when they are sold to another football club. Required. Discuss how to account for the player's contract costs, including the contingent performance conditions, any impairment which might be required to this non-current asset, and whether a player can be considered a single cash generating unit.
Okay, thank you. So now the discussion is in your hand. The football lovers. Okay. What do we do? Okay. You see that whenever players are being acquired, you see that they have a contract, isn't it? Whenever a club purchase or whenever a club bought a player, they are going to sign a contract, isn't it? Okay. So you see that the club, like maybe I'm a Man City fan, so maybe like a club like Man City, the time that we bought Haaland, we pay the transfer fee. Okay, the transfer fee is for the player. So maybe we sign a 5-year contract with Haaland. All things being equal, we assume that Haaland is going to be with the company for what? For 5 years. It's going to be with the club for 5 years. So maybe we paid a transfer fee of 50 million. This particular cost will be capitalized and amortized over 5 years. It means that Haaland will be with us for 5 years. So he is going to generate economic benefit for us for 5 years. So every year, what is the benefit? We match the cost that we spend on it for that particular year. You see that we are going to be paying agent fee. Okay, we are going to be paying agent fee too. The agent fee will also be added to this particular one. So maybe agent fee is 5 million. Before Haaland can start playing in England, we have to register him with the English FA. So we are going to be incurring registration cost of 3 million. Okay, so we'll be incurring a registration cost of 3 million. So all of this one, we have the 50 million, which is the amount that we have paid plus the agent fee. We are paying the agent fee to get a player. So it's a cost necessary to bring the player to the club. And the registration fee is also a cost that is necessary to bring the player to the stage or to the condition that he can start playing. So we now be having 58 million. So this 58 million will now be amortized over the player's contract life. Okay. You will see that included in the contract, we also be saying that, okay, we are going to be paying you a bonus if you score goals of this one. We are going to be paying you appearance fee and those things. You see, those things are just like a normal bonus that you are paying to the company. It will be treated as an expense. It will just be treated as an employee's benefits. It's just like every year when your company makes profits, they will give you a year bonus. That is an expense for the company. It's a bonus. It will be treated as a bonus. It will not be added to the initial stage, because we can't start paying the player before the player will start playing. So it is a cost that is incurred after the player is playing. So the cost that we should incur before the player will be ready to play, we have incurred those costs already. So that will be after cost, and that will be treated as part of the employee's benefit. It's just like your salary plus the bonus. So it will be treated as a profit or loss item. It is treated as part of the employee's benefits, the benefit that the player will be getting. So it will, whenever those bonuses and those things are paid, they will be treated as part of the employee's salaries. Okay. We purchased the player with the cost that we incur on the player is 58 million. It can happen that the player is now injured for 3 months and the player will not be able to play again. So if the player suffered a long-term injury, then we now assess the player. This particular person will not be playing. If the player is back to, he will not be He will not be in his best form. So what we do is that whenever the player suffered a career-threatening injury, we carry out an impairment test on that particular player. So it means that for 3 months, the player will not be playing. And we are saying that every year you have to be doing something. Every year you have to be doing something. So the course will be spread over 5 years. And this year you play for only maybe 9 months. It means that the benefit that you'll be giving it will be lower than that particular one. So we carry out an impairment test on the player. If the player suffers a career-threatening injury, it is likely that the fair value of the player is going to be reducing. The economic benefit that the player will be giving to the entity will be reducing. So we carry out an impairment test on the player. We can determine the fair value, less cost to sell. If we want to sell a player in the situation now, what is the amount that the people are offering for the player? What is the cost that we are going to incur? So you look at the next realizable value. What after the player is back for the injury, what is the expected economic benefit that the player can give to us? This particular player will go and appear in maybe World Cup, and FIFA will pay us this amount of money. This particular player can also represent his country in European League or maybe Euro League, and they are going to be paying them for appearance. The people will be paying us for something. We can also sell the jerseys for the player. And what is the sales that we'll be getting from the jerseys? These are the cash flows that will be coming from the player. So we can now discount those cash flows to their present value to determine the value in use. Okay, then we now see whether there's any impairment loss on the player. So the impairment loss will always be when the injury is long. Even if the player is on bench, it means that the player can still play. But the football, not all the people can play. We only do the impairment when there is an injury, which is a long-term injury. If the injury is 1 week, it's not an issue. 2 weeks, not an issue. But 3 months and those ones that can prevent a player from playing for a season or majority of the season, the player will not play. We use we carry out an impairment test as a result of that. Okay. A player can be, although it is a teamwork, but a player can what? Generate a cash flow on its own. Why are we saying this? If Haaland should go to World Cup and play, FIFA will pay Man City for his appearance. Jerseys of Haaland can be sold individually, which is going to be generating a cash flow. So the player can be treated as a single cash generating unit, although he's going to be for the team. If you want to win, it is going to be a teamwork before you can win a trophy. But what happens to what the cash that we'll be getting from the sale of the players' jersey? What is the benefit that we'll be getting from FIFA if the person should go and represent the club? They will pay to if they are playing World Cup. At the end of the day, FIFA will pay a fee to their respective clubs. This is also a cash flow relating to what? To the player. So a player can be treated as a single cash generating unit. All right. So that is about it. So you just explain with those particular. So the bonuses and those things should be treated as an expense as when they are incurred. Okay. But the registration cost, the initial cost before the player will be ready, the registration cost, the cost that you acquire the player, the agent fee, and all those things should be what? Should be capitalized. Okay. Let's talk about something. Let me talk about something. You can see that there will be a situation where we are going to be having extension. The player will extend the contract. So maybe Haaland, we acquire him for 5 years. Okay. The cost is 58 million. So we're going to amortize it. Every year is how much?
11.6.
Okay, 11.6. Okay, let's assume that Haaland has played for the team for 3 years. It means that it is left with 2 years remaining on the contract, isn't it? He has played for 3 years already. So it will be remaining what? 2 years on the
2 years.
contract. Okay. So what will be the carrying value of the player? What will be the carrying value as at this date after the 3 year? The carrying value will be 23.2, isn't it? Is it
Yes.
23.2? Okay. Let's assume
Yes.
that after the 3 years, he has decided to extend his contract by additional 2 years. What will now be the total contract for the player? What will be the remaining contract life now?
4 years.
Okay.
4 years.
Okay. You can see that you might incur additional costs relating to the contract. Maybe you might also pay the agent. You must pay the agent for the negotiation now. So any cost, any additional cost that you are going to be incurring as a result of what the extension, the agent fee, and all those things will be added to the carrying value. And maybe we paid 5 million for the agents now for the renegotiation. We pay 5 million to the agent. We printed some papers, we signed some papers. We now have additional cost of 5 million. So we now have 28.2. That will be what? That will be amortized over 4 years. Someone will ask about what about a salary increase? The salary increase is as a result of the performance. So that will be treated as what? As an expense. It's just like a normal salary. All right. So that is all about the accounting for those issues. Let's come to revenue from contract with customers. Okay. Before you can recognize revenue, let me just tell you the basic principle. You can only recognize revenue when control, ownership associated with the goods has been passed on to the what? To the third party. It has been passed on to the third party. If you are selling a car, I've given you money, but the car is still with you. You are still using the car. You haven't sold the car to me. So revenue can only be recognized when control, ownership, risks, maintenance associated with the item has been passed on to the third party. Revenue can be recognized at a point in time, at a point over time. When do we say revenue is recognized at a point over time? We have construction contracts. If you are given a contract to construct a story building, if you finish the ground floor, the person can move on with the family. It means that you have finished with that side and the person has now taken the control of that side. So you determine the percentage of you completing the total value of the work. Then you recognize revenue based on the portion of the work that has been done. Okay. Sometimes the thing will be a construction contract, but still the question will say that the company has no right to additional cash flows. It means that a company cannot request for cash flows. You can only recognize revenue when you have the right to additional cash flows. Although the contract will be a construction contract, completion will be recognized over time or construction will be over time. But the question will say that the company has no right to what? To additional consideration. If you don't have any right to additional consideration, you cannot recognize revenue at a point over time. You can only recognize revenue up to the what? The upfront payment that you have received. Maybe the company can pay you an upfront payment. In that particular case, you will now assume that the revenue is recognized at a point in time. So at a point over time, it's a situation where the company has control of the side of the work that you have done has been passed on to the what? To the customer. And the company also has a right to what? To additional cash flow as the contract is going. Okay. So you have to take note of these particular situations. At a point in time, it means that you can only recognize revenue when control ownership associated with the asset has been passed on to the customer. So sometimes the person will be making an upfront payment, and the question will say that the company recognizes revenue at a point in time. The amount that you have received from the person should be treated as a loan, which you'll be charging interest on using your borrowing rate or the interest rate at the date of the transaction. So you'll be charging interest on it. Okay. There can also be a situation where you sell to the person. You sell to the person today. You sell to the person today 20 million. Okay. The goods will be given to the person today. Control and everything has been passed to the person. But the person is going to be paying 20 million in 2 years' time. So there will be an element of finance component over there. The person is paying 20 million, and this 20 million is not the amount or it's not the value of what you are selling. The value of what you are selling is different from the 20 million. But because the person will be holding your money for 2 years, you are adding a portion of interest over here. So the question is, if the person should have cash today and pay, what should have been a cash price? So we find the present value of this amount. The present value will be the revenue that you'll be recognizing. How do you find the present value? It's just the normal present value. There you have your future value divided by 1 plus r exponent n. Then you use the incremental borrowing rate or the interest rate for the company that is what? That is selling. So the difference between the present value and the future value will be an interest. So you recognize the interest as a finance income in the statement of profit or loss as time goes on. So these are the important things that you'll be seeing in the revenue. Another one is also we have issues where two items will be sold together. But if you are selling them separately, their prices will be different. So maybe the company is selling Jesse, the Jesse is 5 million. Okay. And they are also selling maybe sneaker. The company is selling the sneaker. The sneaker, if they are selling the sneaker as an item on its own, it is 15 million. But the company is selling the two to you now at 18 million. In actual sense, what should have been the total selling price for the two items? What should
20 million.
Okay, it should have been 20 million, isn't it? But they are now giving the two to you at 18 million. It means that they are selling to you at a discount of what?
2 million.
Million. 2 million.
So these 2 million, which portion is for the JC, which portion is for the sneaker? So we call something standalone items. So we determine their price separately. So the 18 million over here, which portion of the 18 million is for the JC and which portion of the sneaker is for which portion of this particular is for the sneaker? What we do is that in actual sense, the price should have been 20 million, which JC will be taking 5, sneaker will be taking 15. So it means that the 18 now is for 20. So how do we share it? We take their individual prices over the total price times the price that they are giving to us. So 5 over 20 times 18, that will be for JC. Sneaker will be 15 over 20 times 18. We use their respective selling price to now share the amount that you are receiving. Okay. Sometimes too, the company can be, they will say that, okay, I've given you my machine, my computer that you should repair it for me. So I'm saying that you are charging me 200 Ghana cedis. But I'm telling you that if you're able to finish within 24 hours, okay, I'll be able to give you additional 50 cedis. Okay. That is what we call variable consideration. You can only include this particular 50 million as part of the amount that you are charging me. If you are sure that you'll be able to finish within the 24 hours. So you can only recognize or you can only say the revenue or the contract price is now 250 million if you are sure of completing the work before 24 hours. If you are not sure of completing it, you don't recognize as part of revenue because it's based on the condition and you cannot be able to satisfy that particular condition. You cannot be able to satisfy that particular condition. So you recognize a revenue of 200 million if you're able to finish the work within 24 hours. If you're not able to finish the work 24 hours, you can't recognize revenue because you haven't performed the obligation. The obligation is to repair the phone for me within 24 hours and give it to me. You haven't done that, so I cannot pay you. Revenue cannot be recognized. All right. These are the few things that I can talk about before we pick the question. Okay. So let's pick the question 1.
That's the one. Stopper Limited, SL, sells electrical products at following standalone prices. Products E1, 30,000 cedis, E2, 30,000 cedis, and E3, 50,000 cedis. Required. Calculate transaction price to be allocated to each product under each of the following independent situations. A. SL offered to sell 1 unit of each of the above products for 90,000 cedis. SL regularly sells 1 unit each of E2 and E3 together for 70,000 cedis. B. SL offered to sell 1 unit of E1 and 2 units of E3 for 104,000 cedis.
Okay. I'm sure that is the end of it. Okay.
Yeah.
So you can see that they have given you the selling price for each of, if you want to sell the item one by one, you can see this is the cost that they are giving to you. If you are selling them as an individual item, these are the prices that you are going to sell them. Okay, they say you should calculate the transaction price to be allocated to each product under each of the following independent what situations. Okay, they say that SL offer to sell 1 unit of each of the above products for what 90,000. It means that I'll pick E1, E2, E3, each of them, one of them, and sell the 3 of them for what 90,000. Okay, they are saying that another situation is that SL regularly sells 1 unit of E2 and E3 together for 70,000. Okay, so what you do is that if the company want to sell each of the units for what? For 90,000, what will be the price for all of them? The first step is to find the total individual prices. If you are selling them one by one, what would have been the total amount that we should have received? If you are selling them one by one, E1 will be 30,000. Okay. E2 will be what?
2030.
E2 will be 30.
Okay.
Okay. And E3 will be what?
50,000.
Okay. So if you are selling them, in actual sense, what should have been the amount that we should receive? 110,000, isn't it? Okay. But what is the price that we are receiving now? We are selling each of them for 90,000, isn't it?
90,000.
Okay. So what will be the price for what portion of the 90,000 is for E1? So you find that one. So that will give us 30 over 110 times 90,000. Then you come to E2. E2 will give you 30 over 110 times 90,000. Okay, then you come to E3. That will give you 50 over 110 times 90,000. What are you getting for each of them?
The first one is 245454115.
Okay. So 2, 4, 5, 4, 5. Okay, the second one will be the same price, isn't it? 2, 4, 5, 4, 5. Okay, the last one give us what?
40909.
Okay, 4090.
909.
Okay, can we make it okay, let's
409090.
okay. This one I've made a 24545. I didn't approximate, I didn't do that one. So let's just subtract that one from 90. Okay, so I'm having 40,910. Is that correct?
Linus,
Yes, yeah.
Yes, sir.
it's 30,000, 30,000, but you made 30, 30. So that's why he's giving you the 4.
Okay.
The normal price, you hang the 3 zeros and you didn't hang the 90 3 zeros. So if you are hanging the 3 zeros for then how should be?
No.
No, it's the same.
It's the same thing. You see, This one, I'm doing this one to be 90,000 in full, but I don't want to write 30,000 over 110 because I'll cancel that before I'll do it. So if someone can do 3 over 11, you see that the 30,000 over the 110,000, you count these zeros before you multiply. So someone can do 3 over 11, 5 over 11 multiplied by that party, the 90,000. Okay. So that is if they are selling each of them for 90,000, that is it. Okay. But they are saying that the question is saying something there. Okay. So they said that SR regularly sells one unit each of E2 and E3 together for 70,000. So you first assume that if they want to sell them one for 90,000, this is the price. But right now, out of the 90,000 that we are receiving, out of the 90,000, we are selling one unit of the which ones? E2 and E3. We sell the two of them for what? 70,000. Okay. So they say that the person regularly sells this one for 70,000. So it means that E1, from what we are saying, E1 will be sold for 20,000. Do we agree? On the second part there, XR regularly sells one unit each of E2 and E3 together for what? 70,000. So it means that E1 will be sold for what? 20,000. Do you agree with that?
Yeah.
We are still using the 90,000. Okay. We are still using the 90,000. So first you assume that if they are selling them one by one, what should have been the price? That is the price that we have calculated. Right now, let's assume that because this is for the A, let's assume that the company is selling all of them for 90,000 again. But E2 and E3 can be sold together for 70,000. It means that the E1 is sold for what? 20,000. Okay. If you are selling the E2 and E3 together, what should have been the actual price that you should get from them? If you are selling E2 and E3 together,
80,000.
80,000. But how much are you receiving
80.
now?
70.
Okay. So the 70, it means that there's a discount of 10,000, isn't it? Okay. So we find the price for each of them. So we have the E2 that will give you 30 over 80. It's for only the two. So 30 plus 50, that should be the actual price. Multiplied by the 70,000. Then you come to E3. That will give you 50 over 80 times 70,000. What are we getting for each of them?
The first one is 250.
Okay. 26250. Okay.
And the second one is 43750.
43750. Okay, so these are the prices under each of them. So if you are selling each of them for 90,000, E1 will be sold for 245,245,245. The same thing for the E2 too, but E3 will be 40,910. But right now, if you decide to sell E and ET together for 70,000, E2 will be taking 26,250. E3 will be taking 43,750. We assume that you are selling all the three for 90,000, but you want to sell E2 and E3 together for 70,000. So E1 will be 20,000. The rest will be shared among those ones. Okay, I hope we are okay with that. Okay, let's come to the B part.
Hello, Sir Rebecca, can you go back small? Done.
Okay, okay. So let's go to the B. Who is reading the B for us? They are saying
B.
that, okay,
SL offered to sell 1 unit of E1 and 2 units of E2 for 104,000 cedis.
okay. The question now is, if you are selling 1 unit of E1, how much should you have sold it?
30,000.
Okay,
30,000.
so E1 would have been 30,000. Okay, if you are selling 2 units of E3, what should have been the total
100,000.
you should receive? That would be 100,000, isn't it?
Yeah.
So the total amount that you should receive should have been 130,000, isn't it?
130.
Okay, but the
Yes, sir.
amount that you are receiving now is what?
104,000.
So you do 30 over 130 times what? 104,000. Okay. Then you do the E3, you do 100,000 over 130 times 104,000. How much are we having for?
One will be 24,000.
The first one is 24,000. Okay. The second one is what?
Second one,
Is
not one,
it going to be
80,000.
80,000? Okay.
80.
Okay. So it means that the company is selling each unit of E3 for 40,000, isn't it? Okay. That is very simple. Okay. I want to talk about contract over time, but I don't want to. I want to just take one. Okay. The first one is also something that is completed over time, and let me look at the second one also. And okay, I can use. Okay, I can use. Okay, if I can use the first one, I can use the second one to solve. The understanding for the third one will also come. I can also use the third one to solve. The understanding for that one will also come. So someone should pick the one that we can solve. Which of them that we should solve? Read before you mention them. Don't just look at it and say we should solve this one.
Software.
I should solve 3. Is it the way it is plenty, or can you deal with the bonus over there? Okay. So let me solve the 3. Okay. Someone should read the 3 for us.
Question 3. Bridge North has undertaken a $5 million contract to repair a railway tunnel. The contract was signed on 1 April 20X8 and the work is expected to take 2 years. This is a contract where performance obligations are satisfied over time, and progress in satisfying performance obligation is to be measured according to percentage of costs incurred to date. Bridge North has an enforceable right to payment for performance completed to date. At 31 December 20X9, the details of the contract were as follows. Total contract value, 20X9, $5 million. 20X8, $5 million. Cost to date, $3.6 million. 20X8, $1.8 million. Estimated cost to completion, $900,000. 20X8, $2.2 million. Cash received to date, $2.4 million, 20X9 and $1.5 million, 20X8. Required, compute the revenue, cost of sales, and hence profit Bridge North has to recognize in the statement of comprehensive income for the years ended 31 December 20x8 and 20x9. How much contract assets liability is to be recognized in the statement of financial position as at 31 December 20x8 and 31 December 20x9?
Okay, that is nice. So this is what? This is a construction contract. And which of the method are they using? Input method or output method? What method are they using to determine the percentage of completion? We have two methods, input and output. Which of them are they using?
Output.
Hey,
They're using input.
they're using input. Whenever they say,
We are estimating it.
yeah, whenever they say they are measuring the performance cost to percentage of the cost incurred to date. It means that we take the cost out of the total cost to complete the contract. So we take them one by one. Okay, 2x8. What is the total contract value? The total contract value is the amount that you are charging the company for the contract for the 2 years. So it's 5 million. What is the cost incurred to date?
1.8.
Okay. What is the cost that we are expecting to incur to complete the contract? Okay. So in 2008, in 2S8, if we want to complete the contract, what will be the total cost that we are going to incur to finish the contract in 2008? What is the total cost that we are estimating to incur? That will be what?
Million.
I want to hear the figure well.
4 million.
Okay, that will be 4 million. So our percentage of completion, okay, our percentage of completion will be computed like this. So the percentage of completion, if you are using the input method, it will be cost incurred to date over the total cost. What is the total cost that you should incur to complete the contract? We have already incurred 1.8 million, and we are estimating that before we can complete the contract, we will incur additional cost of 2.8. It means that the total cost to complete the contract, the total cost of the contract will be the one that we incur and the one that we are expecting. So we have the 180 over here divided by 400 times 100. What are you getting as percentage?
45%.
40.
45.
Okay. So what you do is that the revenue that you can recognize for the 2008 will only be 45% of the contract revenue. So what will be the revenue that you should recognize? 0.45 times what? The 5 million. What are you getting?
225.
22.
250.
Okay, just do it in thousand. Okay, I'm having 2250, isn't it? Okay.
2250.
Okay, what will be the cost of sales? That will be 0.45 times the total cost of 4,000. What are we having?
1800.
1,800.
1,000 what?
800.
Okay. If you are using the input method, the cost of sales will always be the what? The cost incurred to date. Okay. So what is the profit on this particular contract?
450.
450.
450, isn't it? Okay. Someone can also calculate this 450 like this. Look at this one. Because the question is asking us to determine the revenue and cost of sales and the profit. That is why I'm doing it like this. Someone can also determine it like this. Okay. In 2S8, what is the total profit that we are making on the contract? The contract price was 5,000, and the total cost that we are incurring is 4,000. What will be the total profit on the contract? Would that be 1,000?
1,000.
Okay. So
Yes.
if we are to complete the contract in 2x8, the total profit will be 1,000. But we are not able to complete. We only complete 45%. So you multiply by 45%, then you get a 450. That's, you can calculate your this one direct. Okay. But since the question is saying that we should show the revenue and cost of sales, that is why I did it one by one. Let's now come here. If you want to bill the customer as at this date, if you want to bill the customer, how much are you going to be billing for the work? If you want to bill the customer as at this date, how much will you be billing for this particular work? Okay, let's take it to practical terms. Okay, I've contracted you to work for me. Okay, maybe you have a printing shop that I'm saying that you should do printing for me. Okay, the printing, you are going to be doing it in numbers. So right now, the printing that you have done, you have purchased a paper, which is 2,000 Ghana cedis. Okay, you have purchased a paper for 2,000. If you don't want to make profit on the contract, I should be giving you the 2,000 Ghana cedis, isn't it? Because that is the cost of the paper that you have used to do the printing for me. Is that if you don't want to make profit, I should refund the 2,000 to you, isn't it? Is that the case?
Yes.
Okay.
Yes.
Okay. The printing that you have done, you have made a profit of 500 on it. So if you want to bill me now, how much are you going to be billing me?
2,500.
You'll be billing me what? The cost that you incur up to date plus what? The profit, isn't it? All right.
Yes.
So the billing that a company will be doing, so we determine contract assets. So I'll be billing you 2,500. And how much have you paid me? What is the remaining balance? The remaining balance is what we call the contract asset. Some people can call it receivable, some people can call it inventory. It depends on the situation where it is coming from. So we have the contract asset. We always have the cost incurred to date, which is 1,800. Then you add your profit to it. If you want to bill the person, this is the amount that you are going to be billing, 450. But how much was received? How much was received for 2x8?
1,500.
Okay.
1,500.
So what will be the remaining amount? What will be the remaining amount?
750.
It will be
750.
7 what? 50. So this is the amount that the company will be showing in their statement of financial position as contract assets. This is for 2x what? 8. Let's count to 2x9. You have to be very careful with the first year one is not difficult. But the second year on, you have to know that the cost that you are incurring is relating to the what? To the old contract. Okay. This place, the contract price will still be what?
Lionel, please let
Yeah.
me see something under the first one.
Okay.
Hello, sir.
Yeah, senior.
It is like this material is different from the previous one.
No, it's the
Okay,
same
thank
material that we are using. Which one do you have? Is it day 2?
The 2 years.
Yeah, day 2 is inside. So scroll down, you will see it.
Page 7.
Sorry?
Someone is trying to mention the page to you. If you scroll down, you see standards, you see financial instruments, then you see intangibles.
Page 7. Page 7.
So it's under revenue.
Oh, okay.
All
Okay.
right.
Thank you.
All right. So, senior, have you seen what you want to see?
you. Yes, Lionel.
Okay. Okay. So let's now count to the 2x9. Okay. That you have to know that the 2x9, the items given to you over here are the accumulated what? Cost. Okay. You see that you have incurred certain costs in what? 2x8. And you have incurred a cost of what? Another cost in 2x9. But if you put it, you are incurring the cost for the contract, so the cost will be accumulated. So all these figures over here are accumulated figures. It is only the first year that we do the specific profit, specific cost of sales. The remaining ones will be done on cumulated costs or on cumulated basis. If you are constructing for someone, in the first year you have constructed this portion of the assets. In the second year, you will now ask yourself, what is the work that I have done so far on the asset? So you determine the work that you have done so far. So far means from the beginning of the construction to this time now. Okay, so don't do the profit for each of the years like separate item. You'll be misleading yourself. Okay, let's now come to the 2x9. The contract price will still be the same thing. That is the amount that we have agreed on. But in 2x9, what is the cost incurred to date?
3.6.
Okay. What is the expected cost that we are expecting to complete, to use to complete the contract?
900.
900.
Okay. So in 2x9, what is the total cost of the contract in 2x9?
4,500.
Okay. So we determine our total cost to be 4,500. Okay. The cost incurred to date is how much?
3,600.
600.
Okay. 3,600. So what will be the percentage of completion up to the second year?
80%.
Okay. So we have 3,600, 3,600 over 4,500 times 100. That will be 80%, isn't it?
Yes, please.
Okay. So let's come to the revenue. The revenue will be 0.8 times what? 5,000. How much are you getting?
4,000.
You are getting 4,000, isn't it?
Yes.
Okay. That figure should have been a revenue that you should recognize up to date, isn't it?
Yes.
Yes.
This is the revenue that you should recognize up to date from the starting of the contract up to today. The revenue that you should recognize should be what? 4,000. But in 2x8, what was the revenue recognized?
2250.
Okay.
2250.
So what will be the remaining revenue to be recognized? So you do this and subtract the 2250 from it. So the revenue that you'll be getting on will be the total revenue should be recognized so far. But in 2x8, you recognize 2250 out of this revenue. So what will be the remaining one that should be recognized in this year? That's what we do.
1750.
1750. I hope we are okay with this particular one. Okay. Let's come to
Yes.
cost of sales. Cost of sales. The cost of sales will be what? Will still be the 0.8 times the 4,500, which will be the same as the cost to date. But that cost to date, this is the cost that we should incur up to date. But we have already recognized the cost of what? 1,600. 1,800 rather. So we should be having 1,000 what? 800. What is happening there?
Loss.
There will be a loss of what?
50.
Okay. Okay, there will be a loss of 50. Okay. Let's now calculate our contract assets. Okay. Let's now calculate our contract assets. Okay. Assets will be on cumulated basis. Okay. So let's now come here. What's supposed to be the cost incurred to date?
3,600.
3,600, isn't it? Okay. What should be the profit on the contract up to today?
Minus 50.
No. What will be the profit on a contract up to today? Let's look at here. You see that at the end of 2x4, 2x5, the total cost of the contract is 4,500. That is the cost that we are saying that we are going to be incurring, isn't it? Okay. And the contract price is what? Is 5,000. It means that the total profit that we should recognize to now be 500. But we have done 80% of the work. So multiply by 80. What are you getting?
400.
400, isn't it? Okay. And that is the same as the 450 minus the 50. The profit that we recognized for last year was 450. Are you okay? So if you subtract the 50 from it, you'll be getting the profit so far. So the profit on the contract should be 400, which is 450 minus 50, 400. Okay. But what is the cash that we have received up to date?
Mm, so, 2,000.
The cash is
2,400.
okay, 2,400. Okay. What will be the total? The total. What will be the
1,600.
1,600? Okay. This 1,600 is up to date. So what do? We recognize 750 last year. So what we do now is maybe we can just find a difference and say that is the amount that we should recognize this year. That will be 950. Someone can also do the contract asset for this year, just this year like this. So the person can do contract asset for this year like this. The person will use the cost incurred to date, the cost incurred to date, the cost incurred for only this year. That will be 1,800. Okay. Then the person will now, it's a loss. So the person will bring the loss of 50. Okay. Then the person will now bring the cash that you receive for. So what will be the cash that you receive for 2x9? What is the cash received for 2x9?
2,400.
2,400.
No, please. Is cash received to date?
It's 900.
Okay. It will be 900. It means that they put the two cash together. So the cash received to date, it means that the 2x8 is part of this one. So that will be 900 for all in this year. Are we okay? Okay. So we subtract 900 from this one, which is the cash received for all in this year. What are we having? We'll be having the same figure, which will be 1,750 minus 900, 850. So I'm sure that it will be 1,600 minus 750. Okay, that will be 850 for all of them. So you can subtract the 750 over here and get the 850. So that is all. Okay. But the most important thing is the recognition of the revenue. If you are recognizing the revenue, you recognize the revenue on cumulative basis, but you take the previous year's own from it. Okay. Let's move on to another standard. Okay, let's tackle the leases. Okay, I don't want, yes, Inia.
Be like I'm lost. So it like I'm having a different question here.
Are you sure?
Uh,
Or you are using CR?
this no.
This thing is starting with what? In your document, what? Okay, is it published account?
Sorry.
Is this thing having a published account or is having consolidation?
It's the same. It's having published account.
Okay, then you should scroll down. Scroll down. If you scroll down, can you see IFRS 15 revenue from contract with customers?
Yes, I can see. Yeah, I have that one.
Okay. The question 3 on that particular, under that one, the question 3. Can you see this person? Can you see this name?
Yeah, I can see that one.
Okay, that is the question that we are currently solving.
But this question 3, I don't have it.
Are you sure?
Yes.
Hey, your question 3 is I've deleted. Then you are
Uh-huh.
you are using the first one because I deleted the first one so that I can add this. So go to the
Uh-huh.
group and download the second one that I've shared
Okay.
because I deleted the first
Okay.
one. All right, thank you.
You're welcome.
Mm. So let's look at the leases now. I hope we are okay with this one, isn't it? Okay,
Yeah, I'm okay with this one.
let's look at the leases. So I don't want to talk about the list that much. Your own will not be the complicated. You will not be seeing the complicated issues in leases, but you can see sell and lease back because they have examined that one in the FR before. The reassessment of lease liability will not be there. So you will be looking at the basic lease issues, maybe the lease accounting.
Mhm.
The FR people can be the CR people can be doing the lessor accounting, but I have video on all of them on my YouTube channel. Lessee accounting, I break them one by one. Lessee, lessor, sell and lease back, and the reassessment of lease liability. So this the lease basically we are saying that the lease is just a contract between two independent parties where one of them has agreed to what to give out his or her an asset to another person who will call the what the lessee at a fee, which we call a consideration. So the lease can be a finance lease or it can be an operating lease. What do we call a finance lease? Finance lease is a situation where risks, maintenance, insurance, control associated with the asset has been passed on to the lessee during the lease period. So during the lease period, the lessee will be seen as the owner of the assets. Or a finance lease, a situation where the lessee has the option to purchase the asset after the lease period, or the lease term covered what half of the what of the useful life of the assets. So they can give you some situations in the question to tell you that okay, this is a finance lease. But what you have to know is that for finance lease, the maintenance and all those things are going to be associated with what the maintenance, insurance, and those things are being passed to the lessee. And the lessor has no right to what to replace the assets. So the asset will be there. There will not be any replacements of the assets, and the asset will be there the for the lease period. So the lessee will have an option. The lessee will have an option to purchase the asset after the lease period, or the ownership of the asset will pass on to the lessee after the lease period. The lease is going to cover substantially the lease period will cover substantially uh, most of the useful life of the asset. So if the asset is for maybe 20 years, you are leasing it for maybe 12 years or 13 years, that will be seen as a finance lease. There are so many characteristics over there for you to know that this is a finance lease. So you can go and read about them. So let's take the first question. Let's take the first question. If it is a finance lease, what do we do? The lessee has to recognize a right of use. The right of use is the right that the lessor is giving to the lessee for the consideration. So since the asset, I'm going to do maintenance for the asset, I'm going to insure the asset. It will be like the asset is my own within the lease period. So we use substance over form. It doesn't matter who is the legitimate owner of the asset, who is benefiting from the asset more. The asset, who is enjoying the economic benefits associated with the assets, it is going to be the lessee. So we use the substance over form. What do we do? The lessee accounting, initial recognition. What do we do? Initially, if the asset is being given to the lessee, how should the lessee recognize the asset in the books? How should the lessee recognize the asset in the books at the date of the transaction? That is what we call the initial recognition. The lessee has to debit right of use. Okay, the right of use is the value of the asset that is given to them. Okay, so the lessee has to debit the right of use as an asset. Okay, how do you determine the right of use? It is the amount that I'm owing you, which is a lease liability, plus any initial deposit, okay, any direct cost. The right of use is treated like maybe PPE. So any cost that lessee is going to be incurring before the asset will be ready for use will be capitalized. So the the direct cost can be maybe delivery cost, it can be installation cost. So they will put all those costs together and see is the direct cost. So all those costs that you'll be incurring to make the asset that you have leased ready for use will be capitalized. So dismantling costs will be part. Maybe you have to carry out a work on the what on the asset. Maybe you have to it is a building. You have to do an extension to it. You have to change some things before it will be ready. All those costs that you are going to be incurring before you start using the building or be ready for use must be capitalized, like the way we do for the the tangible asset, the PPE. So the same principle over here. If the building is just uncompleted building and you'll be paying, you have leased it, you'll be paying. It means that you have to come and complete some part of it. It is going to take maybe a substantial period to complete. And you have taken a loan to finance that. The borrowing cost will be capitalized during the what? The construction period. So all those things that apply to the PPE will also be applied to the right of use. So that this, if there's any dismantling cost, you add the present value to it. So the right of use is just accounted for like the PPE, the PPE. Then what do we do? The company has to create a lease liability. So you credit the lease liability. What do we call the lease liability? Okay. The lease liability is just the cash price that you should be paying to the person for the assets. Today, because I'm holding the money, I'm not paying you. So if I should pay you the money today, what will be the amount I'm paying you? That is the lease liability. So we just present value all the cash flows. So we have the variable. We can have a variable consideration. So some of the consideration they will say that it is based on maybe inflation. So if the inflation rate is high, it will also go high. We can also have the fixed consideration where you'll be paying 10 cities at the end of every year or in arrears or in advance. You can also have the guaranteed residual value. The lessee is telling the lessor that, okay, after the end of this one, we can guarantee you that this is the value that you are going to be selling the asset. So the guarantee, if you have any options and you are sure that the option will be exercised, so if you have options, maybe the person will now have the option to extend the lease period. At the date of the transaction, the lessee must determine whether the option is exercisable. So you present value that one too. They must also have the option to what to purchase the assets. If it is exercisable, you have to what? You have to also present value. So the lease liability is just the present value of all the payments that the lessee will be making to the lessor. We can also have termination. We also have penalty. Okay. There also be a clause in the listing that the person can terminate the lease at this period and the person will be paying this amount. If the termination is exercisable, then you can now include it. Okay. We also have the lease period. The lease period is just the period that the lease will be what? The contract period. So the lease period can be the contract period, the normal one. So the normal lease period. Okay. Then we can also have maybe the option. If the option is exercisable, you add the option period. Okay. You can also have a termination period. Maybe the lease period is 5 years, but they are saying that if you are able to terminate at the end of the 4 year, you will pay this amount. So if you are terminating, the lease period now will now be the termination period, not the 5 years again. Okay. Sometimes you'll be given the useful life of the asset. You'll be given the useful life of the asset. Okay. You'll be given the useful life of the asset and you'll be given the lease period. Okay. Under normal circumstance, the lease period should not be more than what? The useful life. No. Why should you be saying that the asset has a useful life of 5 years and you are telling me that the lease period is what? You are leasing the asset for 8 years. It doesn't make sense. So if you are having a useful life and then the lease period, the period that you are going to be using will be the lower of any of the two. Okay, those are the things that you'll be looking at. So let's pick that question and see how and go about it. So Auntie Bernice, are you there?
Yes, sir.
Okay.
On 1 July 2010, Jumaso PLC began to lease a plant under a 5-year lease. The economic life of the property has been estimated at 8 years. The lease rentals payable by Jumaso were 5 million cedis, payable annually on 30 June. At the end of the lease term, Jumaso has an option to purchase the plant for 10 million cedis, which is expected to be 15% below its prevailing fair value at the exercise duty. On 1 July 2010, Jumaso incurred direct costs of 1.2 million in concluding this lease. And on 30 June 2011, Jumaso made the first rental payment. At 30 June 2011, the end of the lease purchase price has not been revised. An applicable discount rate is 8%. In line with IFRS 16 leases, prepare extracts of the financial statement of Jumaso for the year ended 30 June 2011.
Okay, so that is it. And okay. So what is the lease period?
5 years.
Okay. And what is the lease rentals?
5 million Ghana.
Okay. How is it paid? In arrears or in advance?
In
In
arrears.
arrears.
Okay. Because it is paid on 30th June. So and today is 1st July. So you can't pay yesterday for something that you are coming to take. No. So it will be in arrears. Okay. At the at the at the end of the lease term, Jomasu has an option to purchase the plant for what 10 million, isn't it? Which is expected to be 15 million below its prevailing fair value at the exercise date. Okay. On 1st July 2010, Yamasu incurred direct cost of 1.2 million in concluding this lease. Okay. And on 30th June 2011, Yamasu made their first rental payments. At 30th June 2011, the end of lease purchase exercise price has not been revised. An applicable discount rate is what? Is 8%. Okay. Is there any indication telling you that the option is exercisable? Is there something over here telling you that the option is exercisable? The company is going to be exercising the option. Did you see something like that?
No, sir.
Okay. But you can see that the 15% is below. You can see that they are saying that it is 15% below its fair value at the exercise date. Although that will trigger like the company is likely, but no. The question has to tell you that the company is what is sure, or the company at the date of the lease, the company is sure that they are going to be exercising the option. If nothing is said, don't go there and be assuming for anything. No. Although the 15% means that, okay, I want to buy something. I want to buy something. You are telling me that. Okay. So you are telling me that if I want to buy that thing, the price I'm going to buy it will be 15% below the value at that date. Okay, it looks tempting, but do I have the money to pay? So they have to be sure that the option will be exercisable. If nothing is said, you just ignore the this thing given to you. Okay. So let's now have our So the first of all, you determine your lease liability, the initial recognition. Let's look at the initial recognition. The initial recognition, initial recognition. Okay, so the initial recognition will be the lease liability. The lease liability, we have the years, the cash flow, the discount factor, and the present value. The discount factor will be the interest rate implicit in the lease or the incremental borrowing rate of the lessee. How much are they paying every year?
5 million.
Okay, so the 5 million, we are using annuity because it will be equal amounts at the end of every year. So you can use annuity. Don't go there and be doing 1 year. You do year 1, year 2, year 3. You are wasting time. Okay, so since it's an equal amount, you can use annuity. Okay, so let's use the annuity. What's the annuity factor for 8% for 5 years? Do you know how to calculate the annuity? Okay, annuity is calculated as 1 minus into bracket 1 plus R exponent negative n divided by R. The R is the rate, the N is the years, is the number of years. What are we having?
3.99.
3.99.
Okay, 3.99. That is all. Okay,
Three.
okay,
3.
okay. Multiply by the 5 million. How much are you getting? I'm getting,
19.9.
okay, okay.
19.97.
I'm getting 19.95.
Hmm.
Okay. So the question now is, if you see the lease liability means that if the company should have, if they should have cash today, this is what they should be paying. Okay. If they should have cash today, this is what.
Sorry,
Yes, please.
which of the rate did you use?
I'm using 8%.
Oh, okay.
Okay. So currently I'm owing you 19.95 for something that you are giving to me. The meaning is that the value of the thing or the cost of what you are giving to me is the 19.5. That is why I'm owing you what? The 19.5 million. So you have given something to me and I'm saying that I will pay you in 5 years' time. And you are saying that if I should pay you today, the value is 19.5. It means that what you are giving to me, the value is 19.5. That is why if there is no other cost, the right of use is the same as what? The lease liability. Because today that is what I'm owing you. I'm owing you for what? The asset that you are giving to me. So the value of the asset, the value of the assets. So we now go to the right of use. So the right of use, the first thing will be the lease liability. If there is no other cost or there is no advance payments, the right of use will always be equal to the lease liability because you are giving, it's something that you are giving to me because I'm owing you 19.5. So what you are giving me today, the value of it is 19.5. That's why I'm owing you 19.5. The difference between the amount that I'm paying you is just the interest component, but the company incur a direct cost. And I'm saying that this direct cost can be installation, it can be delivery, it can be testing. It will be all those direct costs that are capitalized under PPE. So how much is the direct cost? The company incur direct cost of what? 1.2. Okay. So what will be the total cost under this one? So let's now look at subsequent measurements. Okay. Don't go there and be preparing table because they are asking you to do the list for only 1 year. Okay, the subsequent measurements. The subsequent measurement, you have your lease liability at the start, which will be 19.95. You only do table if they are asking you for so many years because you can't be doing it one by one. So you put it in the table to save time. So what you do is you now have your finance cost. The finance cost will now be 0.08 times 19.5. What are we having? Then you count to the lease rentals. It will be paid at the end of the year. Okay. So I'm currently owing you 19.95. If you should charge me interest on this amount, it will be 8%. But at the end of the year, I have paid you 5 million. So the 5 million will be reducing the debt that I have with you. Okay. So 0.08 times 19.95. I'm getting 1.5596. Is that correct?
Yes.
Okay. So that will be 1.60. What will be the balance?
16.4.
16.55. You see, this 16.55, someone can decide to show it as a current asset and also current liability. So what you do now is, if you want to show the current asset and you want to show the current liability and non-current liability, you calculate the finance cost on this amount. That will be 0.08 times 16.55. Okay. How much are you getting?
One point
1.32.
Okay. Okay. Let me look at the depreciation before I will come and explain that one to you as a finance cost. And also, so the depreciation of the right of use will be 21.15 divided by 5. What are you having?
4.23.
Okay, 4.23. So if you go to statement of profit or loss for this year, you have a finance cost of this and you have depreciation of 4.23. But if you go to the statement of financial position, I want to show you how you can split. It is not compulsory. You can show this as a lease liability, as non-current liability. Nobody's going to do anything. Okay. You can see that the next year, the amount that we'll be paying will be 5 million, isn't it? Okay. The 5 million consists of the interest payment and then the capital payment, isn't it? The 5 million that you are paying as the renters, part of it is for the interest, part of it is for the capital. Okay. But the 5 million that you'll be paying in the next year, you can see that 1.32 out of it is for what? Is for the interest. And the interest will always be paid at the end of the year. But how much of this one will be the capital? Will be for the capital that you are paying, will be for capital payment. Interest is charged at the end of the year. So that will be paid at the end of the year. So how much will be for the capital payments? 3.68, isn't it? Will it be 3.68?
Yes, 3.6.
So it means that the 5 million, we'll be paying the 5 million at the end of the year. That 5 million that we are paying interest for next year, which is 1.32. The interest will be calculated on this particular balance before we subtract the what? The 5 million. So the 5 million that we are paying in the next year, we are paying interest at the end of the year, which is 1.32. But 3.68 of it is just the amount that we are paying, which is at the beginning of the year. So we can say that we are paying 3.68, which will be at the beginning of the year, but the interest will be at the end of the year. So if you count your current liabilities, 3.68. How do you get that? Calculate the finance cost for the next year. Just take it for the principal. The amount that you are going to be getting will be the 3.68. And the difference between the 3.68 and the liability at this year will be your non-current liability. So you just come to the right of use over here. That will be 21.15 minus 4.23. So the right of use will be shown as carrying value. So you count your current liability. Okay, your current liability will be calculated as, okay, so you come to finance lease. Okay, under the finance lease, your current liability will be calculated as 5 minus 1.32. So that will give you 3.68. Your non-current liability, which will be a finance lease, will now be calculated as the 16 points, because the actual balance that you should be owing the person at the end of the year is 16.55, but you are showing 3.68 as a current liability. So what portion will be the non-current liability? That is what we show. So in all, if you put the two together, you'll be having your balance of 16.55. That's how we go about it. Very simple. All right. What's the time? 8:49. We have some 1 hour more. Let me look at the standards. So I will just explain the two. Okay. I will just
Linus,
yes, Senior.
the splitting that you did will confuse me small about
So
the one
okay.
1.32 that you are subtracting from the rental payment.
So how do you want to get confused? You want to get confused more or small?
It's no, you are confused me small.
Yes. So I want the
That
level of confusion that you want.
no,
You don't want at all.
I don't want to be. I don't want to be confused.
Okay.
So that
So let's
if you
come here.
can,
Okay. What is the amount that you are currently owing the people?
you are owing them 16.55.
Okay. If you want to charge interest for the next year, the interest will be charged on this amount, isn't it?
Yes,
Okay. And that will be 1.32, isn't it?
yes.
Okay. The next year you'll be paying 5 million, isn't it?
Yes. But the 5 million is at the end of the year that
Yes, that is next year,
because
isn't it?
paid. Yes,
You'll be paying next year. Okay. This particular interest will also be paid next year, isn't it?
yes.
Okay. The question now is, we'll be paying this 5 million next year, which 1.32 out of it is for the interest. Okay. What will be the portion that will be for the capital? The capital, we can say we are paying the capital at the beginning of the year, or the capital will accrue at the beginning of the year. So out of this 5 million, we are paying 3.68, which will be paid immediately. We can say that it is paid immediately, or it is payable immediately at the beginning of the year, because it will not accrue interest. So this 3.6 out of it, we take it from this one to be a current liability, which is payable maybe immediately the next year. Okay. Or if you like, you can decide to just leave it at the non-current liability 16.55. Nobody's going to do anything. But the 5
Okay.
million that we are paying, 3.668 out of it is this year. It is the interest that will be paid at the end of the year. The interest is the one that is payable at the end of the year. But the 3.68 out of it, which is included in this place, will be paid immediately, or is payable immediately at the beginning of the year. So what you do is that this 16.5 that you should show as a non-current liability, you are going to be taking the capital payment of it as a current liability, which we have over here. But the difference will be 12.87, because we are subtracting the 3.68 from this figure. In other words, if you put the two together, you'll still be having your 16.55. No problem. Okay.
Okay, thank you.
I hope the confusion has reduced more. Okay.
Yes, please.
Okay. Let's now I will explain the footnote 2. Okay. I will explain the footnote. I will explain the two. Okay. The lease period is agreed as what? 6 years. However, the lease contains an option for OL to terminate the lease at the end of 4 years upon payment of 1 million. OL is reasonably certain to exercise this option due to anticipated technological changes. First annual installment amounting to 12 million was paid on 1st January 2020, and all subsequent annual installments are payable on 1st January, subject to decrease of 2 million in each year. When are they entering into the lease agreement?
First
First
January.
January 20.
Okay. When was the first installment paid? When was the first rentals paid?
First January.
So they are
2020.
so they are paying in advance, isn't it?
Yes, please.
Yes.
Okay. So market rate for this particular one is market rate for similar transaction is 12% per annum, but as an incentive to OL for entry into the lease, FBL has incorporated an implicit interest rate of 11% per annum, which is known to OR. So you use the interest implicit in the lease. Okay, the fair value and the useful life of the machine are 40 million and 7 years respectively. OL incurred initial direct cost of 3 million. So what you do is forget about the fair value given to you. The fair value will be useful for the lessor. But as the lessee, you should always recognize the asset at the lease liability plus any direct cost or plus any amount that you are here to, or any initial deposit. So let's come here. What is the lease period? In the question, what is the lease period?
6 years.
Okay. But they are saying that the person has the option to terminate the lease at the end of what? 4 years, paying what? 1 million, isn't it? Okay.
Yes.
So the question now is the termination possible? Is the company certain that they are going to terminate?
Yes.
So if they are going to terminate, what will be the lease period now?
4 years.
4 years.
The lease period will be 4 years. Let's now calculate our lease liability. Okay. So the lease liability is always calculated based on amount that you are here to pay. Okay. So we have the years here. We have the cash flow. We have the discount factor, which is 11%. Then we have the present value. So year one, how much are we? You can see that we have paid 12 million already, isn't it? Okay. The second payment will be done at the end of the year. So we only calculate the lease liability based on the remaining amount that you are here to pay. If you have paid 12 million already, it means that you're not owing the person. We are looking for liability. So the lease liability will always be calculated based on the remaining rentals. So year one, we have already paid what? 12 million. The question says that the lease rental is what? Is subject to a decrease of 2 million in each year. So our next payment will be how much? We have paid 2 million
10
already.
million.
Okay. The next one will be 10 million. Okay. So year one, which is a year from now, will be 10 million. Okay. Year two, how much will it be?
8 million.
Okay. And the year three, how much is it going to be?
6 million.
Okay. 6 million. 6 million plus what?
That's 1 million.
1 million.
Okay. So that will give us 7 million. Okay. Someone will be asking why we are using this one. The lease is at the lease starts, the lease as from January. So the amount that you'll be paying right now is this one. From you have already paid what? 12 million. It means that remaining what?
3 years.
Remaining 3 years. Okay. So the year starts now. So from now to the end of the year is 1 year. From so the lease period will now be what? 2020, isn't it? So January 2020 to 2021. Okay. That will be 1 year, isn't it? 2022 will be what?
Yeah.
Yes.
Okay. 2023 will be what?
Yes.
Okay. So we have already paid what? 12 million now. It means that this will be 10 million. Are we okay? Okay. Then this will be 8 million. This will be 6 million. Okay. So it means that the lease period starts now. So from now to the end of the year is 1 year. From 2021 to 2022 is also another year. From 20 from 2022 to 2023 is another year. So what I will do is that let me just remove this one there and put the years here. So we are going to be having 2021, 2022, and 2023 so that it will not confuse us. Are we okay? Okay. 2020 has
Yes.
been paid already. Okay. Okay. So what will be the discount factor for each of the years?
The first one is 0.901.
0.901. Okay.
0.812.
812.
Okay. 0.812. Okay.
0.731.
Okay. Let's come. No, let's come here. The This one, when are they paying it? The termination, when are they paying it? It's at the end of the year, isn't it?
Yeah, it's at the end of the year.
So
Yes.
this supposed not to be 7, supposed to be 6. So we have 2024 here, so that we have 1. Okay. So do the 2024, let's see. Because this one, we assume that they are being paid at the beginning of the year. You can see that the remaining ones are paid at the beginning of the year. That's why we have remaining what? Remaining, that's why we have a
0
remaining
0.659,
0.659.
659.
Yeah, let's take it again. The 2021 over what we have over here is at the beginning of the year, isn't it? 2022
Yes, there
is at the
is.
beginning of the year. 2023 is at the beginning of the year. But we pay in 2023 and use it for what? And use the asset for full year. So we have to bring the 2024. So that will be done in
Sir,
yes, please.
please, the 2021 discounting factor, won't it be raised to the power 2? Because it's the second year.
No. We don't do it like that.
No,
The first year will be 1.00.
Okay.
Year zero will be 1.00. So we don't do it like that. Okay. All right. I hope the the termination is okay now because we are doing it as if it is also paid in advance. No. Okay. So let's get the cash flows one by one. Okay. So if you get a lease liability, your right of use will be calculated like this. So you get a lease liability over here. Then you add your advance payment to it. You add 12 million to it. Then you now add a direct cost. Let's look at the direct cost. Okay. The direct cost is 3 million. Then you now do the way we do it. So 3 million. Okay. Okay.
so first one, 9.01.
Oh, now I don't want to waste time on it. I want to, we have a lot of questions again. We have 1 hour. We have less than 1 hour, 30 minutes. So let's just move on to the next one. All right. Okay, let's take this one. Okay, who is taking it first?
Question 1. IS 33 earnings per share. The issue share capital of GH Trust, a publicly listed company on the Ghana Stock Exchange, at 31 March 20x7 was 10 million cedis. Its shares are denominated at 25 pesos each. GH Trust earnings attributable to its ordinary shareholders for the year ended 31st March 20x7 was 10 million cedis. Year ended 31st March 2028. On 1st July 2007, GH Trust issued 8 million ordinary shares at full market price. On 1st January 20x8, a bonus share of 1 new ordinary share for every 4 ordinary shares held was made. Earnings attributable to ordinary shareholders for the year ended 31st March 20x8 were 13.8 million cedis. Year to 31st March 20x9. On 1st October 20x8, GH Trust made a rights issue of shares of 2 new ordinary shares at a price of 1 cedis each for every 5 ordinary shares held. The offer was fully... So are you there?
Yeah, I'm here.
Okay.
I should go top.
Yes.
Okay.
The offer was fully subscribed. The market price of the company's ordinary shares immediately prior to the offer was 2.4 cedis each. Earnings attributable to shareholders for the year ended 31 March 20x9 were 19.5 million Ghana cedis. Calculates GH Trust's earnings per share for the years ended 31st March 20x8 and 20x9, including comparative figures.
Okay. All right. So what I want to do is that I want to modify. This will be like, if you're adding 2024, it will be like the year is 5 years. So let me just do at the end of this year, at the end of 2020, which is at the end, then I have 2021 over here. But anyhow you do it, you still be having the same thing. Then I have 2022 over here. Then you have 2023 over here. They will all be the same thing. The assumption is that the first cash flow will come at the end of the year. Okay. But you find your lease liability, add it and depreciate and amortize. Okay. Let's count to this. This is earnings per share. Okay. Okay. You have to know that the earnings per share looks at only two types of what? Two types of issues. We have the basic earnings per share and we have the diluted earnings per share. The basic earnings per
Hello,
share.
sir.
Yes, yeah.
You changed the years once again.
Yeah, I said I want to
And
make
I
it.
want
I want to. You see, the 2020 means that it is at the end of the year. So we are receiving the 10 million at the end of the year. Okay. The 8 million, we have already paid the 12 million. That is the beginning of 2020. Okay. The years means that it's at the end. It's at the end. It's at the end. Whenever you are discounting, it means that you are assuming that the cash flows will arise from a year time at the end of the year. So 2020 means that we are receiving the money at the end of the year. So if beginning of 2021 is the same as the end of what? 2020. Is that not the case?
Mm-hmm.
That first
So
January,
my question is,
December. Yeah.
won't the cash flow be 12 million?
No, we have received the cash flow. We have paid the 12 million already, which is at the beginning of the year. But the 2020 that I'm putting over here is at the end of 2020. But the 12 million is paid at the beginning of 2020, so we can't use it.
Okay.
Okay, so that the years over
Thank you.
here are all indication of at the end of the year. At the end of the year. Okay. Let's count.
Wouldn't it be this?
Is that?
I was asking that we can't we use the first one, just put at the
Exactly.
beginning there.
Exactly. But if you are counting it, it will be 5 years.
Okay.
If you count it from 2020 to 2024, it will be 5 years. Okay, that's why I don't want you to, if you are revising, you should not confuse it. So you just put 2020 over there, means that the cash flow is coming at the end of 2020. You have already paid one already. So the next one, which will be at the end of 2020, will be the one, the next one, which will be 10 million. So that you can be able to put your 1 million at the end of 2023. Okay. But if you go with that one, since you can be able to adjust it very well, there's no problem with that. Okay. All right.
Okay.
All right. Thank you. So I'm saying that for the earnings per share, we have basic earnings per share. The basic earnings per share is the actual earnings per share. Okay. Right now, what is the number of shares that the company is having? Currently, based on the actual result, what is the number of shares that we are using to get the profit? So what is the number of shares that a company is currently using to get a profit that they are generating? That is the basic earnings per share. If you try to express the profit for the year over there, shares that is generating that particular profit, you say basic earnings per share. But right now, the companies currently have a convertible instrument that can be converted in the future. Okay, the question now is, if this particular instrument should be converted now, what will be the effect on our earnings per share? So it's just an assumption that if the instrument should be converted now, what would be the impact on our earnings per share? The company has share options, which will be which will be exercised in the future. The question is, if these options to be exercised now, what will be the impact on our earnings per share? That is what we call the diluted earnings per share. So the diluted earnings per share, we are just assessing the impact of future equity items on, please a minute then. All right. So let's come to the question is asking us for basic earnings per share. The basic earnings per share is just that, okay, you have made a profit of 8 million. The 8 million is for the full year. Okay, but you have shares of 10 million at the beginning of the year. But on 1st July, you have issued a new shares of 6 million. Okay. The impact that these 6 million shares will be having on the 8 million, is it going to be a full year impact or only some months impact, isn't it? What is it going to be, a full year impact, or is going to be having some month impact on the profit for the year?
Some months.
Some month impact.
Okay.
Some months.
And that will be how many months?
6 months.
6 months.
Okay. So the question now is the impact that this particular new issue is having is 6 months. So it means that what we have to do is that we should just find, it's only 6 month profit that is over here. So what is the profit per share for that 6 months? So we find the 6 months share and now what? Divided by the impact that they are having. That is why we do the work. The work we are just looking for, okay, included in the profit for the year, the share that we issue, the new shares are not having a full year impact. It will be only the 10 million that will be having what? a full year impact on this one. So this one we don't pro rata because it will be 12 times 12. But the new issue that we have done, what will happen? The new issue was not there. The shares was not there. So from that time, from the beginning to the time that we issue, it has no impact on the profits. So the profit that we are adding is only the 6 months. So the shares that we can use for the calculation should also be the 6 months. So that is how we call the WACC. So that is the idea about the WACC. I cannot give you, you cannot be selling in the market for a full day. You have sold from the beginning, you have sold from 6 a.m. to 1 p.m. and you have made a certain profit. I have given you an amount from 1 p.m. and you have closed at 6 p.m. The only portion of the profit that I can have a share of is 1 p.m. to 6 p.m. Okay, so that is the basic idea about the WACC, the reason why we calculate the WACC. Okay, let's count to the first one. Okay, let's calculate the earnings per share for the first year first. So the first year, the basic earnings per share. So we have the 202x7, our basic earnings per share will be calculated as the profit attributable to this one over the number of shares. Okay, sometimes you can multiply the answer by 100 if you know that you are going to be getting pesos. So we have the profit attributable to this one. Not only profit after tax, profit attributable to the ordinary shareholders of the company. So you'll be having, for you people, you are not going to be examining on complex issues. Okay. Sometimes the question can be giving you the irredeemable preference shares. So the irredeemable preference shares, their dividends will be subtracted from the earnings. But for redeemable, they are treated as debt instruments. So their dividend has been treated as a finance cost, which is already subtracted. So our basic earnings per share will be calculated as, so let's come to the basic earnings per share. So what is the earnings for the 2x7? They have given you the years one by one. So look at the 2x7. For the year ended 2x7, what is our earnings?
10 million.
Okay. Earnings is 10 million. Okay. What will be the number of shares? I want someone to give me the number of shares.
What's it?
How do you get a 48?
10 divided by 25. 0.25.
Okay. I'm having 40 million.
It's 40, I said, but you heard it 40.
Oh, sorry. So this one, we know how to calculate it. We issue a certain number of shares at 25 pesos and we are having a value of what? 10 million. We have done that in the consolidation last week. So we are all familiar with this one. So the number of shares, the value of the shares is 10 million. How many shares do we issue at 25 pesos to get a 10 million? You just divide and get a 40 million. So that will give us 40 million shares. So would that be 0.25?
Yeah.
Okay. So we make it 25 pesos. So you just multiply your answer by 100. The earnings per share should be calculated in the what? In the highest denomination of the currency. So if it is 0 point something, just multiply it by 100 to change it to pesos. Let's now come to the year ended 2x8. Okay, let's come to the 2x8 here. Okay, what is the earnings for the 2x8? The earnings for 2x8 is 13.8, isn't it?
13.8.
Okay, so we have the basic earnings per share to be 13.8 million divided by a number of shares. Let's go and do workings for that one. Okay, you see that the existing shares, okay, existing shares, which is 40 million, will be there for a full year, isn't it? Okay, then we count to something again. Let's count to something again. Okay, so let's come here. On 1st July, 2023, 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 1st the GH Trust issued 8 million ordinary shares at a full market price. At a full market price. Okay. The year end is 31st March, isn't it?
Yes.
From July to March, how many months is that?
9.
Okay.
3 months.
Okay. That will be 9 months. Now it's 2x7 to 2x8. So it's the next year. It's 31st of next year. So that will be 9 months. Okay, look at the date very well. One is 2x7, one is 2x8. Okay. On 1st January 2x8, a bonus issue of 1 new ordinary shares for every 4 shares held was made. Earnings attributable to ordinary shareholders for the year ended 31 March. Bonus issue is not time apportioned, isn't it? Bonus issue is on the existing shares. So we assume that we are changing the results for the company to what? To existing shares. Okay. So the bonus, there was a market issue first before the bonus issue. So let's come here. It's very simple. It's not anything. Let's come here. We are going to be having the full market issue. Okay. The bonus issue, what is the proportion?
1 to 4.
Okay, 1 for every.
1 over.
Okay. So the bonus issue will always be on the existing shares. What were the shares existing before the bonus issue? You see that we have 40 million, which is from the beginning, isn't it?
Yes.
40 million of the shares. And we have 8 million, that will be from July, isn't it? Okay. So the bonus issue will be on these existing shares. The bonus issue is not time apportioned. We are not going to be saying that we will start what? We will start the bonus issue from January. No. It will assume that the bonus issue has been in existence from the beginning that the company has been incorporated. So let's come to the ratio now. It will be 1 over 4, isn't it? Okay. The bonus issue on the existing shares will be what?
10.
10,000
Okay. So
or 10 million.
that will be 10 million. So someone can just move forward and say this will be 10 million and this will go for 12 months because it is at the beginning of the year and the person will be getting 50 million as the existing shares. Or someone can just multiply this by bonus fraction. So we have 1 over 4. You add 1 to it, that will give you 5 over 4. So the bonus fraction is 5 over 4. So the person will multiply this particular thing by the bonus fraction. So 5 over 4. And the person will get a 50 million straightforward. The person will get a 50 million straightforward. And this year's has been there for full year. They have been there from the beginning to the end of the year. So we have 50 million shares. Okay. Let's come to the full market value. What will be the bonus issue on the full market value? It will be 1 over 4 times 8. That will give us what? How much? What will be the bonus issue shares on the full market value?
2 million.
It will be 2 million, isn't it? Okay.
Yeah.
And if you add the 2 million to the 8 million, what are we having?
10 million.
Okay. And these shares will be there for how many months? They have been there for only what? 9 months. So someone can do 10 million. Someone can do 10 million times 9 over 12. Okay, what are you getting? And I will show you how someone will also do it. And we have another way of doing it again. I will show you that one too. So 10 times 9 over 12. I'm getting 7.5. Okay. Someone can also do the 7.5 like this. The person will be doing the 8 million multiplied by the bonus fraction. Okay. The person will do it like this, multiply by the bonus fraction, then multiply over 9 over 12. That will give the person 7.5. And we'll be getting 57.5, isn't it? All right. Let's look at another way of calculating the bonus fraction. What the standard says. The standard says that you should apply the bonus fraction up to the time of the what? The issue. Okay, so someone can also do it like this. Someone will say that the existing shares, okay, that will be, the existing shares will be 40 million. Okay, but the bonus fraction will affect it, so 5/4. The bonus issue will affect it. But this shares has been there for 3 months before the new issue, isn't it? That the person will come to the full market value. Okay, the full market value, the person will say that, okay, the company will now have 48 because the new share is 8 plus the existing one, that will give you 48. The bonus issue will affect it. And this will be there for only 6 months before the bonus issue. Is very complicated, so I don't really do that one. Okay. And the person will say after the bonus issue. Okay. So the person will say after the bonus issue, then the new shares will now be, you will now apply the okay. The new shares after the bonus issue will now be what do you have? 48. So 48 times 5/4. I'm having 60 million. So the new shares, the bonus issue will be on the 48 now. So that will be 60 million shares times 3/12. So if you do it one by one, you will still be getting 57.5. And this is very complicated, so I don't really encourage what the standard is saying. Just ask yourself, the full shares will always be there for full year. So just do it over 12. Now come and tackle the new shares that are issued during the year. That's how you go about it. But going about this particular thing, you don't even know what you are doing. So you can do all. You'll be getting the, so I'm getting 15 over here. 40 times 5/4 times 3/12. I'm getting 12.5 here. And I'm getting 30 here. So if you do it, you'll be getting the same answer. But I hope you like the first one. Okay. The first one is just a small thing that you have to think about. Okay. So what will happen now is we do it divided by 5.7 million, 57.5 million. What are we having as the earnings per share?
24.
Okay. So times 100 will give us 24 pesos. Are we okay? Okay. Let's go to the last year. Okay. Last year we are going to be having 2x9. Okay, 2x9, what is the existing shares at 2x9? What will be your shares at 2x9 now? What do you think will be the total shares at the beginning of 2x9? It will be 50 million, which is the what? The existing shares plus the bonus issue for the existing shares. Then it will be 8 million plus the bonus issue on the 8 million. So that will give us 60 million. Okay. So the bonus, we have 40 million before we issue additional what? 8 million. And we have done a bonus issue on each of them. So multiply by 1/4 plus the 40. Multiply by 1/4 plus the 8. So the total shares will now give you the 60 million. So that will be the shares that we'll be having at the beginning of the year. So at the end of every year, look for the existing shares. We issue 8 million shares in last year. So that 8 million shares will now be ready for this year. 40 million was there before that one will also be ready. By then, we made a bonus issue on each of them, 1/4. So you find 1/4 of that one, add it to the existing share, you'll be having 60 million. Let's come to the basic earnings per share for this year. Okay. What is the earnings for 20x9?
95.
Okay. 19.59. Okay. Let's come to what will happen. What happened there? On 1st October, 2x8, the GA Trust made a right issue of two new ordinary shares at a price of what? 1 cedi each for every 5 ordinary shares held. The offer was fully subscribed. The market price of the company's ordinary shares immediately prior to the offer was 2.4 each, and is attributable to the shareholders for the year ended 31 March 2x9 were 19.5 million. Okay. What you have to know is that you have to know that the 60 million shares will now do a full year in what? In 2x9. Do we agree to that? 60 million shares will now do a full year in what? In 2x9, because the 8 million will now be ready, which will be used from the beginning of the year to the end. The bonus issue will also be ready. The 40 million, they will also all be ready. But this is what? This is a right issue. The first thing that you have to know is you have to know your right issue fraction. How do you determine your right issue fraction? Okay. The right issue will always have an element of what? Of bonus and also element of full market value. So your right issue fraction is calculated as the cum price or the cum X price over the theoretical XY price. So we are only interested in the theoretical XY price. Let's look at this. What is the price of the what? What is the price of the shares? Before we do the right issue, what was the price of the shares?
2.4.
Okay. The shares were issued at what?
1 Ghana.
So it means that you can see that we are doing a bonus issue of what? 1.4. So we are only selling the shares. There are a certain number of shares that are sold at 1 million, but the shares should have been sold at 2.4 Ghana cedis. So what is the portion of the shares that are being subscribed for? What is the one that is going for the market value? And what is the one that is going for a bonus issue? So the right issue will always have an element of bonus issue and the element of full market value. So we try to separate it by doing or by using our right issue fraction. So the first thing that we have to calculate is the theoretical XY price. The theoretical XY price. I will show you this one, how to calculate it on full market basis and also the total market basis. Okay, let's come to the existing shares. What is the number of existing shares that we have? It's 60 million, isn't it? Is it 60 million? The number of existing shares is
60 million.
okay.
60 million.
One of them is what? 2.4, isn't it? One share is 2.4. So what will be the total value of the existing shares?
Mm,
I'm having 144.
144.
Okay. So we now do a right issue. Okay. What will be the number of shares that we'll be getting from the right issue? The right issue was 245. So 245 means that it will be 2/5 times the existing shares. So 2/5 times 60. What are we getting?
24.
Okay, and each of these shares are issued at 1 cedi, isn't it? So what is the amount that we are realizing from the right issue?
Ghana cedis.
So the total value that we'll be realizing, the total value of the company now will be the value of the existing shares, which is 144, plus the money that you are getting from the right issue. That will give you 164, isn't it? Okay. What will be the total number of
168.
Okay, sorry. 168. I just want to check whether you are active. Okay. What will be the total number of shares now? You see that we have the 60 million plus the right issue of 24. That will give us 84. Okay. The question now is, what will now be the new value of the share after the right issue? the new value of a share. The total value of the equity is 168. The number of the equity shares is what? 84. How do we find the value of a share? How do you find the value of a share?
We take the 160.
168 divided by 84.
What are you getting?
2.
Okay, the 2 is what we call the theoretical extra price. So 168 divided by 84. That is what? 2 Ghana cedi. That is what we call the theoretical extra price. But mostly we use the unit method. This is a total approach. Mostly we use the unit method. The unit method is that we don't bring what? The total value of the shares over here. We bring the unit that we are giving for the new shares. So the theoretical extra price, we have the existing shares to be equal to. So how many of the old shares are we bringing for the new? How many of the old shares? Are you sure?
5.
We are bringing 5. Okay. 5 at what? How much is 1? 2.4, isn't it? Okay. 5 times 2.4 is what? Is 12. Okay. The right issue. How many shares are they giving now? How many rights? You are bringing 5 or 2. So this will be 2 at 1 cedi. The value will give you 2. So that will be 14 and what? 7. Your theoretical extra price will be the 14 divided by 7, which is also 2. Mostly we use the what? We use the unit what? Method. So you now find your right issue fraction. It's very simple, but how we could do them? So the right issue fraction will now be equal to the price before the right issue, which is 2.4 divided by the 2. What are you getting as a fraction? So it is the cum price or cum x price, which is 2.4 divided by the theoretical extra price. So 2.4
1.2.
divided by 2. I'm having 1.2, isn't it? Okay. The 1.2, can we make it like a fraction?
6/5.
6/5, isn't it? Okay. So the right issue fraction is 6/5. 6/5. Okay. Let's now do the work. Okay. We know that the existing shares will be there. The existing shares will be here, 60 million, isn't it? Okay. We are saying that there is an element of what? Bonus issue in the right issue. And this is always the what? The bonus fraction. The 6/5 is always the bonus fraction, which is the same as the right issue fraction. So the question now is, if our bonus fraction is this, so what will be the number of shares over here? What will be the number of shares now at existing shares will now increase to what?
72.
72, isn't it? Okay.
Yeah.
But what was the old shares first? What was the shares that we had before we now having 72?
60.
It was 60, isn't it?
Yeah.
And the shares is now increasing by what?
12.
Okay, where is the
12.
12 coming from?
Right.
Where is the 12 coming from? The 12 is coming from the what? The right issue, isn't it? Okay.
Yes.
So it means that the right issue, which is 24 million shares, 12 of it is for bonus issue and 12 of it is for market value. So the bonus issue will not be time apportioned. You just multiply this by 12/12 because the existing shares will be there for the full year. So we have 72 million over here. Or if you also want to find the portion of the shares or the portion of the shares that is the bonus, you can just do 1/5 or you just subtract 1 from this one. That will give you 1/5. Then you multiply by 60 and get the bonus issue element. That will give you 12. So it means that the total right issue of 24 million, 12 of it is for bonus issue. Then the remaining 12 is for the market value. So you just come to full market value over here. The full market value over here. You take the remaining 12 million and now pro rata. So 12 million times what? When was the bonus issue done? When was the bonus issue done? 1st October. 1st October to 31 March. How many months is that?
5 months.
Are you sure? October, November, December.
Yeah, 5
3
months.
months. 5
It's,
months.
it's 6 months. October, November, December, 3 months. January, February, March, 3 months, 6 months.
6 months.
Okay. So it means that the full market value, which is 12 million, will do only 6 million. So your total will now be 78 million. Okay. So your earnings per share over here, 78 million. What are we getting?
0.25.
Okay. So I'll give you 25 what? Pesos. Okay. One thing that you have to know is that whenever there is a bonus issue, the bonus issue will affect what? The shares that you have from the beginning. So you are going to be adjusting the first one that we did. What is the first value for this one? So this will be, we are going to be adjusting this with the bonus fraction now. Please, someone, this thing is giving me a bad signal. I don't know who is that. Okay. So what we do is that whenever there is a bonus issue, or we can also adjust this. I will show you something like this. Okay. Let's look at the bonus issue done. Okay. The bonus issue done for this year, for the second year, was the bonus issue that was done. I don't want to use that particular one. I don't want to confuse you. But what you have to do is that if you calculate earnings per share, before there is a bonus issue, the bonus issue will affect what? The earnings per share that you have calculated before. So the first earnings per share, which is 25 pesos, will be readjusted by the reciprocal of the bonus issue fractions. So the bonus issue was done twice. So you do 25. Okay, sorry, it will be 4 over 5 first. So the first one was 5 over 4. So we have 4 over 5. Then the right issue fraction was 5 over 6. So we just reciprocate it by 5 over 6. That's what we are going to be having. Okay. So that's the answer that you are going to get over here. I will re-show it for you how you can go about it. So 25 over 25 times 4 times 5 divided by 30. I'm getting 16.67. Okay. Another way of doing this is that you look at all the bonus issue that has been done. All the bonus issue that has been done. So you just take your 10 million, you have your 40 million. There was a bonus issue of 10 million on it. This will assume to be in existence from the time that the bonus issue was done. Okay. The time that this particular earnings per share has been calculated. There was also a bonus issue of 2 million on that one. But that one will be for, it is not at the beginning of the year, so it will be for only one. That will be one. Okay. We come to the other one, the 2009 X9, there was a bonus issue of 12 million. So let's now calculate our new earnings per share now. That will be 10 divided by 50. That will be 63. Okay. So we'll be having 40 plus 10 plus 1 plus 12. Okay, so you'll be having 10 over 60 times 100. Okay, you'll be having 15.87. Okay, there is a difference. So maybe there will be something somewhere. But just restate it. That is all. Restate it. That is all. Okay. 10 over. Okay. So let's move on to the next one. We don't have time. Okay. So you can try, especially the question 2. You can try the question 2 on your own. Let's look at impairment. Let me deal with the impairment. Then we look at the government grants, non-current asset held for sale. Then the remaining one, you can look at them, effect of changes and the borrowing costs. You can look at them yourself. Okay, let me see whether I can do at least 2 standards before we close. Okay, I don't think I can do the non-current asset held for sale, the government grants, but let's take the impairment of assets. Auntie Bernice, are you there?
Yes, sir. Please let somebody read, please.
Okay.
IAS 36, impairment of assets. Telepath company has a year end of 30th September and owns an item of plant which it uses to produce and package pharmaceuticals. The plant cost 750,000 Ghana cedis on 1st October 20X0 and at that date had an estimated useful life of 5 years. A review of the plant on 1st April 20X3 concluded that the plant will last for a further 3.5 years and that its fair value was 560,000 Ghana cedis. Telepath company adopts the policy of revaluing its non-current assets to their fair value, but does not make an annual transfer from the revaluation surplus to retained earnings to represent the additional depreciation charge due to the revaluation. On 30th September 20X3, Telepath company was informed by a major customer that it will no longer be placing orders with Telepath company. As a result, Telepath revised its estimates that net cash inflows earned from the plant for the next 3 years will be year ended 30th September, year 2x4, 220,000, 2x5, 180,000, 20x6, 200,000. Telepath company cost of capital is 10%. Telepath company also owns Realda company, a 100% subsidiary which is treated as a cash generating unit. On 30th September 20X3, there was an impairment to Reader's assets of 3,500,000 Ghana cedis. The carry amount of the assets of Realda company immediately before the impairment were goodwill 2 million, factory building 4 million, plants 3,500,000, receivables and cash 2,500,000. Required. Can you please scroll? With reference to relevant IFRS, show how the above transaction should be accounted for. in the financial statement of Telepath Company for the year ended 30th September 20X3.
All right, thank you. Okay. All right. So if you see this question, what are you going to do? Which side are you going to which side are you going to uh which of the side are you going to tackle first? You tackle the subsidiary side, isn't it? Okay. The Telepath Co. also owns a Radar Co. 100% subsidiary, which is treated as a cash generating unit. On 30th September, there was an impairment to Radar assets of 3.5 million. The current amount of the assets of Radar Co. immediately before the impairment were this value. So what you do is that the impairment of okay, the impairment of the three, you see this one, they haven't given you the recoverable amount. They haven't given you the recoverable amount. They have given you the impairment directly. It means that the recoverable amount is the 12 million minus the 3.5. That was how come they have gotten the impairment. So how do you share impairment to a cash generating unit? How do we share it? How is impairment loss shared to a cash generating unit? Zenia,
We
how?
write off goodwill
Okay,
We write off goodwill.
so the first
and share the rest.
so the first one will be goodwill, isn't it? Okay.
Yes.
After we take the goodwill, what will be the remaining one? It will be 1.5 million, isn't it? Okay.
Yes.
So the 1.5 million, you look at other assets. Some of the assets they can give you their net realizable value. You reduce the impairment to their net realizable value. But this one, nothing is given. The receivables too, they are at their net realizable value. So the receivable and cash, there is no impairment. So if there is no other physically damaged assets, if there is no physically damaged assets, what I'm saying is that you have to take, okay, what I'm coming to say is for only, they will examine more in corporate reporting. You see, sometimes they can give you the factory, they can give you the net realizable value of the factory. Okay. Or they can say some of the assets are, so they can give you the net realizable value over here. Goodwill, they will say not available. But the factory, they can say that their net realizable value is 310,000. Okay, or 3.3 million. And the plants, maybe they can give you plants as maybe 3 million. Okay, 30,000. So this one, they will still give you this one as the, so this one, they can decide to give you 24,000. Okay, or they will reduce it. Okay, so you see that the impairment, the total impairment is 3 million, 3.5 million. Goodwill will take, uh, goodwill will take 2 million, which is 20,000. It will be now be left with, it will now be left with, okay, so let's say that this is taking, so let me just keep three zeros over here. So this one, they will give you, okay, this is not on the question, but I'm just using the question too. So the net realizable value, goodwill will be dash. This will be 3,300. Okay, that will be 3,300. They can give you plants as 3,000. Then this one, they will give you 2,400. Okay, so you know that the impairment is 3,500. Goodwill has taken 2,000. It will be left with 1,005. Okay, this 1,005, you cannot just stand up and say you are sharing it to what? Factory building and plants. We only do that when their net realizable value are not given. What's the value of the factory building? What is the carrying value? What is the carrying value of the building?
4 million.
Okay, but what is the net realizable value?
3,300,000.
Okay, what the building has increased by how much?
700.
700.
So you can only give 700 of the impairment to what? To the building. Sometimes they will give you their recoverable amount. You can only reduce the impairment up to the recoverable amount. You can't reduce the carrying value below the recoverable amount. No. Let's come to the plant. The carrying value is 3,500. The net realizable value is now 3,000. It means that has also reduced by what? 500. So you only apportion impairment of 500 to it. Okay. The receivables were 2,500. Now it is 2,400. It means that the receivable has also impaired by 100. There will be a difference of 200 of the impairment. You don't do anything, you just leave it because there is no asset that you can share the 200 to. Okay. Sometimes the question can also give you the fair value of the asset. Maybe they can say they will give you a footnote that they will give you the building, they will give you 4,500. The carrying value is 4,000 and now 4,500. The meaning is that the building has not impaired. So the building will not suffer impairment. Okay. But let's come to what the question is saying here. Let's assume that these things are not there. Okay. So they can give you a lot of things. You have to be very smart. You can only reduce the carrying value of an asset to its recoverable amount. You can't reduce below the recoverable amount. And sometimes they will give you the impairment, they will give you some value of the asset, which will be higher than their what? Their carrying value. The implication is that those assets has not impaired because they have a recoverable amount that is higher than the carrying value. So there's no impairment on that particular asset. But this place over here, we are having goodwill to be 2,000. The remaining 1,500, which is 1.5 million, will be shared among these people. 4,000 over 7,500 times 1,500. And we have plants will be 3,500 divided by 7,500 times 1,500. What are we getting? For that's 4,000 divided by 7,500 times 1,005. I'm getting 800. And this will be 700. This will be dash. Is that correct?
Yeah.
Okay. So what you do now is that you have to find the carrying value after this. This will be dash. This will be 3,200. This will be 2,800. And this will be 2,500. So you now find your amount now. This will be 8,500. That will be the carrying amount after the impairment. The focus is not here because this is very straightforward. Let's go to where the focus is. Let's go to where the focus is. So the focus will be on the first part, which is PP and impairments. Okay. Teleco has a year end of 30th September and owns an item of plant which it uses to produce and package pharmaceuticals. The plant cost 750 on 1st October 2X0, and at that date had estimated useful life of 5 years. A review of the plant on 1st April 2X3 conclude that the plant will last for a further 3.5 years, and its fair value was 560. Okay, so you can see that they are doing revaluation of the asset, isn't it? So the plant had the cost of what? 750,000 on 1st October. But when are we doing the review? Look at when they are doing the review. At what date is that? 1st April 2X3. So let's come here. The date is 36. So we have the date of, so the acquisition date was October. Acquisition date was October 2X0. Okay. And the cost as at that date was 750,000. Okay. They are now doing the review. The review was done on April 2x3. Okay. From October 2x0 to 1st April 2x3, how many years is that?
Three years.
Are you sure?
2 years, 3 months.
Are you sure it's 3 months?
2 years, 6 months.
2 years, 6 months. 2x1, September 2x1 is 1 year. September 2x2 is another year. But the 2x3 is not September, it's only April. So October to April is 6 months. So that will be 2 years, what? 6 months. So we need to find the carrying value of the asset as at the day that the review is done. We compare with the amount that we have that date. So that will be cost minus accumulated depreciation. So our carrying value will be equal to 750,000 divided by 5 years. Okay, let me find the cost first. So the cost will be 750,000 minus the accumulated depreciation, which will be 750 divided by 5 multiplied by 2.5, because we have used 2.5 years already, 2.5 years already. So we having carrying value is equal to 750 divided by 5 times 2.5. I'm getting 750,000 minus 375,000. So the carrying value will be 375,000. Okay, let's now look at the revalued amount given to us. What is the revalued amount given to you?
Sir, please go over again.
60.
Okay. Go over which one?
What you just did.
Yes. Yeah. From the asset was purchased on 1st October 2x0. We are doing the review on 1st April 2x3. What you know, don't forget about 2x0. Okay, you can just say 210. October 210. Okay. October 210 to 20, April 2013. How many months is that? How many years and months is that? So you can just calculate it. If you are not sure, you can count your figures in the exam hall, or you can write on the paper. Nobody's going to do anything. So you can be there and be saying that, okay, from October 2x 210 to September 211. That is 1 year. From October 211 to September 2012. That is additional 1 year. Okay. From October 2012 to September 2013 should have been 3 years, but we are not up to the September. We only end on April. So from October to April, that will be 6 months. So it is 2 years or 2.5 years. Okay. So the review was done on 1st April. We want to know the carrying value as at this date and compare with the revalued amount to see whether there is a revaluation gain or revaluation loss. How do we calculate carrying amount? It is the cost minus the accumulated depreciation. How do we get accumulated depreciation? We know the depreciation for each year, which will be 750 divided by 5, because the asset is having 5 years with no residual value. So every year will be 150,000. But we have used the asset for 2.5 years already. So we multiply by the 2.5 to know the accumulated depreciation, which will be 375. You take it from the cost, the remaining amount will be 375,000. That is the carrying value of the asset as at the date that the review was done. Okay. Then from this place, you now compare with the revalued amounts. So you are going to be having a surplus. Okay. The surplus will be 560,000 minus 375,000. What is the surplus?
185.
Okay. 185,000. Okay. Let's go to what the question is saying. Let's go to what the question is saying. Okay. On 1st April, conclude that the plant will last for a further 3.5 years, and its fair value was 560. So it means that what's supposed to be the remaining useful life of the asset?
2.5.
Okay, but they are saying that the asset will now last for what? A further 3.5 years. It means that the useful life of the asset has increased by additional 1 year. Okay, so it means that the asset will now last for what? A further 3.5 years. The further means that what? From this date now, the asset now has 3.5 years for the asset to be scrapped or something. So it will last for further, from this date, the asset now has a further 3.5 years to last. That is the remaining useful life now. So we now have 3.5 years as the remaining useful life. Okay. Okay, the company does not make an annual transfer from revaluation surplus, so there will not be anything happening there. Let's come to this place. Okay. On 30th September 2x3, Telepath Co. was informed about a major customer that it will no longer be placing orders with Telepath Co. As a result, Telepath revised its estimate that the net cash flow earned from the plant for the next 3 years will be what? These values. So what they are doing over here is that they are carrying out an impairment test. When are they carrying out the impairment test? It's at the end of the year. So 30 September 2x3. So we have to know the carrying value of the asset as at this date. The carrying value will now be the new value, which is 560 minus the depreciation for the 6 months. So that will be 560 divided by 3.5, because the remaining useful life now times 6/12. So what are you getting over there? 560 minus what? So 560 divided by 3.5 times 0.5. I'm getting 80,000. Okay. The carrying value is now 480,000. Can someone confirm that?
Yeah, 480.
Okay. Let's now look at the recoverable amount. The recoverable amount, you see that the recoverable amount will only be restricted to what? Value in use. Are we okay? Because we are not giving the fair value in the question. We're only giving the what? The net cash flows. So let's look at the cash flows. We have the years, we have the discount factor, we have the cash flow, then we have the present value. The discount factor is 10%. The years will be year 1, year 2, year 3. So what is the cash flows given to us in the question? The first year is what?
$420,000.
Okay, 220,000. Okay, 180 and 200. Okay. Sometimes the question will give you a residual value. The residual value should be added to the last year cash flow, because the receiver, you'll be selling the asset and you receive the money. So the cash flows are the normal trading activities. So if you are selling, it means that you are going to be receiving additional money. So the residual value will always be added to the last year's what? Cash flow. But we don't have a residual value over here. So you just look at this one. The recoverable amount is the higher of the next valuable value and the recoverable amount. So what is the discount factor? 10% for the first year.
0.90.
0.909.
Okay. The second year will give us what?
0.826.
Okay. 0.826. The third year will give us what?
0.751.
Okay. 0.751. Let's find the cash flows. I'm having 1488, 1486, 1486, 80 for this one. Okay. Then
Your one is 199980.
19980. Okay.
Yes.
Year 3 is what?
Year 3 is 150,200.
Okay. 150,200. What is our total cash flow?
Four nine eight eight six zero.
Okay. 4988 what?
8860. 60.
60. Is there any impairment on this asset? Is there any impairment on this asset? The carrying value is 480,000. And this one?
No.
No.
Okay. So there is no impairment
No.
on this particular asset. So it's 1011. Let me see whether I can try. Let me see what standard will also come again. Do you know that government can give you a grant and government can give you a loan and grant will be part of it. Do you know that? Read the government grant question.
No.
Okay, less of this one. Read it.
On 1 July 2016, Wotelewe PLC obtained a government loan of 50 million, which carries interest of 6% per annum, payable annually, and principal is repayable on 30 June 2021. The loan was granted on certain conditions which had all been met on 1 July 2016. The loan was not designated as measured at fair value through profit or loss on initial recognition. The prevailing market interest rate as on 1 July 2016 for a similar loan was 11% per annum. The amount received was credited to loan and finance costs for the year has been recorded at 6%. Required, discuss with reference to relevant accounting standards how the above transaction should be dealt with in Wotelewe's financial statement for the year ended 31 December 2021.
Bernice, are you the one struggling to pronounce the word?
It's Wotelewe.
I'm
I said it.
Okay, I was who is struggling to pronounce this particular word? Okay, you can see that the loan was granted on what? On a condition, isn't it? Even if there is nothing over there, whenever a government is giving a loan to the company, the loan will always be given at a subsidized rate. It will be given at a rate lower than the commercial rate, the market interest rate. Okay, so the company will just assume that, okay, if I'm going to the open market to take this loan, what should have been the amount given to me? So there is a loan component in that particular 50 million, and there's also a government grant component. So we want to separate the two. How do we separate the two? We try to find the fair value of the loan itself. How do we find the fair value of the loan? It's just like the way you do the splitting. How do we do the splitting? We find the present value of all the cash flows that the company will be paying under the loan. So the loan was given on 1st July, and it will be repayable on what? 30th June 2021. How many years is that?
5 years.
Okay.
5 years.
So you see that the company will be paying interest for 5 years. So you find the fair value of the loan. Okay, the fair value of the loan component. Okay, the fair value of the loan components. How do we find that? It's just the present value of all the cash flows under there. So, all right. So how do we do that? We have the years, we have the cash flow, we have the discount factor, then we have the present value. The discount factor, we always use the market rate for a similar loan, and that will be 11%. Okay, the company will pay interest, which is a coupon for 5 years. It will be the same amount for 5 years, and that will be 6% on the 50 million. How much are they paying? 0.06 times 50.
3 million.
Okay, they'll be paying 3 million. But at the end of the 5th year, what will happen? They will pay the principal, isn't it? Okay, the principal will be repaid at 50 million. Let's now calculate the discount factor for the 5th year and annuity at 11% for 5 years. What are we getting? What are we getting? Discount factor for the 5th year.
3.7.
Is it annuity?
Yes.
Annuity is 3 point what?
7.
3.7, just that's all.
It was 3.695.
Okay. 695 what? What is after the 5?
Okay,
8.
8. So
Okay.
696.
Okay, so it will be 3. It should always be to 3 decimal places. So
Okay, so
696.
696
Okay. Let's count to the discount factor.
times 3. Okay.
Okay. So do the discount factor for me. Let me multiply this one times 3. I'm having
0.593.
okay 0.59.
3.
Okay, multiply by 50. 29.65. Okay, 11.08. I'm having 40.738. Okay, so this will be the fair value of the loan. Okay, the difference will give you the government grants. So I'm having 9.262. So let me just make this one to be 40.74. Okay, so the portion of this one is the government grants. Okay, so they say all the conditions has been met. So it means that you can receive the grants. But someone can say that, okay, since the grants, the conditions has all been met, it means that we have performed what we have to perform. So someone can recognize to profit or loss. Someone can also say, since it is given on a loan, let's just what? Let's just amortize over the loan period, 5 years, that is all. But the subsequent measurement will be for the loan. Okay, so we have a subsequent measurement of the loan. We will now calculate, we look at the loan, the fair value of the loan. The fair value of the loan will be 40.74. You now charge your finance cost. The finance cost will be calculated based on the effective interest rate, the market rate. So 40.74. Then you get that value. Then you now count your coupon. The coupon will be the 0.06 multiplied by 50 million. and that will be the 3. Okay. So 0.11 times 40.74. I'm getting 4.48 plus 40.74 minus 3. I'm getting 42.22. Okay. So what they did was uh interest of 3 million was taken to profit or loss, and in the loan they have 50 million there. So what you do now is that the actual interest that should go to profit or loss should be 4.48. It should be 4.48, but you have taken only 3 million. So in the profit or loss, you charge additional 1.48 there. Okay, if you come to the loan amount, we go and subtract the difference. So minus 50. We go and subtract 7.78 from this one. But if you go to profit or loss, you bring the government grants. You have done 1 year already. Okay, let's come here. Oh, the interest should be 6 months. Sorry. The interest should be 6 months. It's not a full year. The loan was given on July. So the interest should be 6 months. July to December is 6 months. So you just multiply this by 6/12. So the coupon will not come here. Okay, but the question still they have paid the interest. So they have paid only 1.5 out of that, because that will be only 6 months. Okay, but let me see whether they have said that the interest has been paid. Credited to this one, and finance cost for the year has been, okay. So no interest has been paid. The interest will be paid at the end of, or they will be paid on 30th June, 1 year in arrears. So this will be dash. Okay. So let's come to the finance cost. The finance cost should be 0.11 times 40.74 minus 0.5, 2.24. Okay, plus 40.74. I'm having 42.98. 42.98. Okay, so in the profit or loss, what they did is that they have taken 1.5 to that place as finance cost, but I figured that should have been taken should be 2.24. So 2.24 minus 2.24 minus 1.5. So we now send 0.74 as additional expense to profit or loss. And the loan, they are having 50 million in the loan. So 50 minus 42.98. That will give us, we now take 7.02 from it. Okay. What will happen is that if you go to profit or loss, you bring other income. Okay, the other income, you can recognize all the grants, but it will be advisable if you amortize it over the loan period. Okay, so 9.26 divided by 5. That will be 1.85. So if you count to liability, you have a deferred income, which is a grants, minus 9.26. Then we are having 4.41. Okay, that's how you account for it. So you debit the interest, you debit profit or loss, with 0.74. You debit the loan with 7.02. You credit the profit or loss with a grant 1.85. Then you also credit the deferred income with 4.41. So maybe if you add the two sides, you'll be getting the same figures. Okay, 0.7274 plus 7.02. I'm getting. Okay, we are going to be having the finance interest. Okay, the interest expense, because we haven't paid the interest 1.5, so we are accruing the interest of 1.5. So that will be treated as a current liability. Okay, we should be paying interest of 1.5, but that hasn't been paid. So the 1.5 will be accrued as a liability. Senior is all. So it's basically about government grants, but it's a financial instrument including government grants. So whenever a loan is taken from government, it will always be given at a subsidized rate. So you look for the portion that is relating to the government grant and also the portion that is relating to the loan itself. How do you do that? You discount the cash flows that the company will be paying under the loan at the current market rate. The figure that you'll be getting will be for the loan, and the difference will be for the government grants. Because there is no condition attached to the government grants and the conditions have been met, it means that you are qualified for the grants. So you can decide to recognize the grants immediately. But since the grant is also is also given for a loan, or it is included in a loan, and the loan is 5 years, you can decide to amortize the grant for 5 years. There is no problem with that particular issue there. All right, so this is how far I can go. The non-current head for a cell question, I've solved it before. It is on my YouTube channel. You can check it out. Just go to IFRS 5, you see a question. The 8.2, I've solved it before. The effect of changes in foreign exchange currencies, there are no issues, but I'll give you some questions again to try again. Okay, I'll give you some questions on standards, partner accounts, ratios, and the console, like some selected questions. Maybe you just solve them and boost your morale. Okay, seniors, if you don't have any concern or any issue, this is where I'll end you people. And the only thing that I can say is that God should do it for you people.
So, sir, I want to find out, will you be having any intervention on FM?
Yes, we are starting FM tomorrow, God willing.
Please, concerning the intervention that you done